India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. Markets are going to be looking better, I think, because global market handover is very, very positive. I'm Prashant. With me, my colleagues Sonia and Rima is with us here on the program today. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Rima. Well, there's been a huge rally on Wall Street, right? I mean, it hasn't helped us so far in the last many days. But let's see, hopefully today is that day when, the markets sort of use that little bit of a bump up.
Well, one of the CNBC anchors said this is a banner day for the US markets with stocks surging, yields declining on the, little cool off that we've seen in the inflation. So banner day was what was the term used.
And let's see if we have a banner day here. We manage that, right? Because last few days has been kind of disappointing because the market comes up and it is up 50, 60 points and it sells off. Yesterday was a case in point, something very similar that we had. Let me just begin by telling you where we kind of left off yesterday and what you need to know. So, as we were discussing, very strong cues from overnight markets, and not just from one market, but you look at the equity market, the rates market, the dollar market, that's a currency market. I mean, it's kind of flashing green across, right? So Nasdaq was up about 1.4%. The S&P was up about 1.25, 1.3%. You had inflation numbers. Basically, there were two data points. Inflation numbers came in at 0.29% growth. That's the core CPI number in the month of April. That was in line with consensus. So markets should not get too excited about that. Well, they were not. But then there was also the retail sales data for the month of April, which came. That was weaker, right? And that essentially, the combination of these two was read pretty dovishly by the market. When I say dovishly, essentially expectations that growth is kind of starting to slow off, inflation is coming off. I mean, that is essentially the combination which the market really liked. By the way, some are still talking about that stagflation scenario. The inflation remains not very, it's not low. I mean, it's in line, whereas growth starts to weaken a little bit. Last time, of course, a reporter asked Fed Chair Powell that question about stagflation. He very uncharacteristically said that I don't see a stag and I don't see the inflation as well. So, that's where we are at. But it's not gone away, that debate. What was the market reaction? Pretty big. The 10-year yield lost 9 basis points. We were down to 4.35%. The dollar index lost, almost 1%. That's a pretty large single-day move, right? 104.21 is where the dollar index is at. We'll put out a chart for the yields as well and the dollar as well. These are significant breaks that we've seen and perhaps, herald another sort of leg down, a phase lower, hopefully. Did Fed implied rates in terms of what the market is betting on for the Fed to do in July change very much? It did not. That stands at about minus 7 basis points. Bulk of the expectations are concentrated in for later, sort of, for example, in September and what the Fed will do there then. Oil prices, they inched up back to where we're at about $83 a barrel, nothing very large. We've been sort of yo-yoing between 82 and 83 for some time now. So that's the global setup, and it's a pretty positive, good setup. Now to the local data point, and I just want to sort of highlight this indication before I get to the levels. FIIs in index futures are pretty much at record short levels. They're not at an absolute low. The low that we've seen, we've also, by the way, had 3.5 lakh short contracts from FIIs. That was back in November of 2023. But we are, in a way, at the first level, almost 2.5 lakh contracts net short from FIIs. On the opposite side is what you call client segment. NSE gives you data on what clients are doing, and this is nothing but HNIs and family offices, basically quote unquote smart money. They are net long 2.7 lakh contracts, and that is near a record high. So you have essentially FIIs who are net short, and you got clients and HNIs locals who are net long. And this in the past has resolved in the favor of local sort of smart money. And FIs eventually start to cover. There is, of course, also you throw in the other angle, which I just spoke, which is the global outperformance we've had for the last 1.5 odd months. And I think we just have to bide our time because you've got this local election event. And once that is over, or maybe even going into it, some of this starts to unwind. That's where we are at not exactly the worst sort of position in the world to be in. Levels here for the Nifty in the very near term. The resistance stands at yesterday's high, which is 22,297. We left off, it's about 100 points away from where we are. The 20-day stands at 22,320. That's the level above, all within the vicinity of about 1.25%. And then the 61.8% retracement of the fall is 22,422. Basically, from here all the way to about 22,400, you got these resistance levels. Bank Nifty crossed the 40-day exponential but could not close above it. So that becomes a natural first resistance, which is 47,840, very close by. And then the first high was 47,957. And then the 20-day comes in at 48,164. These are levels where the market will test. The price action has got to show us that it's willing to cross these levels. And then we kind of start to talk about the fact that maybe this downdrift is over and the market is looking a little healthier, a little better. GIFT Nifty will come up on your screen. It should be a positive kind of a start, 90 points higher. And I think today, more than the last couple of days, I think we should be able to hold on to the gains and not sell off like we've had happening in the last few trading sessions or so. Sonia.
Absolutely. And the good part is, if you realize that after all this volatility, the market is back at that 22,300 mark. So it's not given up on its uptrend. It perhaps saw a bit of a pause for a few days, but now it's back at those high levels. But yes, it is, after the recent pullback, it has been consolidating. The Nifty has been facing a bit of resistance around the 22,300, 22,400 mark. So let's see how that goes from here. But there was a huge rally on Wall Street, as we've been saying, post the inflation data that came through. The S&P 500, in fact, closed above the 5,300 mark for the first time ever, and the Dow was up in the green. So hopefully we'll be, jumping onto that bandwagon today. The FI selling as well, although in our own markets it continues unabated. The amount is lower than what we've seen in the preceding 2 days. So yesterday, FI sold about 2,800 crores. On an average, they've been selling 4,100 crores in the preceding 2 days. So that at least is a positive sign. But I want to talk about a couple of stocks and themes that are in focus. One is, yesterday you had the Aadhaar Housing Finance listing. Now, although it was a subdued listing, it's on the radar of many influential investors. HNI investor Akash Bhansali bought 45 lakh shares on day one. And now Aadhaar Housing Finance is the cheapest actually amongst the entire housing finance space, if you look at the valuations. So it would be very interesting to see if there is fresh buying after the kind of subdued listing that this company saw. No problems with the financials, robust growth, etc. Adani Ports is the other one I'm looking at. The management has guided for 5 years of double-digit growth. So you'd perhaps want to keep that on your radar. But the big theme that I'm watching after earnings season is the return of rural demand. And almost every FMCG company, that came out with their numbers indicated that the rural demand is recovering. In fact, some companies even spoke about how rural is growing ahead of urban. That's what Colgate said a couple of days ago. So whether it's Hero MotoCorp, Colgate, Dabur, they spoke about a recovery. HUL said that there are green shoots of recovery in the rural market. Berger Paints will definitely be a stock in focus this morning because they reported almost a 14% volume growth in Q4. And we know that, they as well have a large exposure in Tier 2, Tier 3 cities. And in the NBFC space, Shriram Finance a couple of days ago said that the rural credit growth is quite good and the asset quality has also improved. So this is one pocket that I'm really looking at because A, of the underperformance that these stocks have seen, so perhaps there's headroom for growth, and B, because of a recovery in rural demand.
No, absolutely. Just want to put on board some of the cues for the day. One, today is the Nifty weekly options expiry. Two, as Sonia pointed out, the FI selling continues. Less compared to the prior day, but yesterday, 2,800 crore of selling, taking the monthly tally to more than 36,000 crore rupees. FIs have sold for every single day in the month of May. Also yesterday, IMD has said that the southwest monsoon will hit Kerala on the 31st of May. So monsoon is pretty much here, and by 15th of July, it should cover the entire country. Day 2 of the Go Digit IPO, and on day 1, it's seen a subscription of close to about 36%. Some levels on the Nifty, on the way down, it will be 21,821, which was the low on Monday, and on the way up, the 21 DEMA, 22,300. In big earnings today, in the Nifty pack, there's only one, M&M, but a lot of F&O companies like Biocon, Gale, HAL, InfoEdge, Concord, all of them will be reporting their numbers. But we've seen a pretty fantastic recovery from the lows this week. On Monday, the intraday low on the Nifty was 21,821. 21,821. So from that level, we've seen a recovery of close to about 380 points. And look at the way PSUs have bounced back. This week, The PSC index is up close to about 3.5%, but top honors go to the metal index with a gain of close to about 4.5%.
Okay, so let's see. The implied opening is suggesting a big opening of about 100 points up move. So I think we have our hands full with some positive cues this morning, but let's see how we take it from there. Here is some commentary coming in. First up, on the equities front, Chetan Seth of Nomura says that moderating US inflation and soft retail sales should bring a relief for Asian stocks in the near term. He sees a relief rally in Asian stocks and it may even overshoot the fundamentally derived fair value index targets. Chetan adds that emerging Asian stocks would welcome an environment of a softer US dollar and moderating US bond yields as concerns for higher for longer should ease in the near term.
Okay, some money market views here. This is on the rupee. Parul Mittal Sena of Sansi, who says that USD INR has been in a very tight range this entire week amid low volatility given an inline expected US CPI and a weaker US dollar. She expects the rupee to trade in a range of between 83.3 to 83.6 to the dollar. Global cues and state-owned bank actions will remain important drivers for the rupee till election results are declared.
Okay, and on the bonds, Parul says last week India rates drifted lower, driven by a down move in global yields. India's inline CPI at 4.83% and liquidity supporting measures via the RBI's repo auctions also helped. In the absence of domestic cues, Indian bond rates are likely to move in line with global rates, which has declined post the US CPI. And she expects the 10-year benchmark yield to move in a range of 7 to 7.1% over the next week.
And we have lots of stock-specific action to track today, and we'll get to it in just a bit. In our special Top 10 segment, we're looking at M&M, Mankind Pharma, Dixon Tech, IEX, NCC, Honeywell Automation, and Titagarh Rail Systems. These are stocks with positive news flow. But on the other hand, Berger Paints, NLC India, Jindal Stainless are stocks on our radar that are likely to open in the red.
Okay, Ed Yardeni, President at Yardeni Research, is joining us now to take some questions. Ed, it's a big day from global markets. Good morning, Prashant here, and thanks for joining us. Dollar has seen a substantial move lower. Yields are down 9-10 basis points in the 10-year, and equities, of course, have rallied on. So very constructive. And is it looking? I mean, should we what should we take away for price action here the coming sessions as well? More coming on the downside? For yields and dollar and maybe upside for equities. Yeah.
Yeah, well, I do think that the data we got today suggests that the inflation numbers are still moderating. The CPI, both on a headline and a core basis, excluding shelter, both of them are right around 2%, 2.1, 2.2%. So we're just waiting for rent inflation to come down. We know that's a laggard. And it is coming down, even in the latest numbers. So I think the Fed's got a really good shot at getting 2% on the inflation rate by the end of the year. Meanwhile, the retail sales numbers didn't bother me too much because they apply to merchandise. And we've seen a tremendous pivot by consumers towards services. So I would say the economy looks pretty good. No stag and no inflation, as you said, and quoting Jerome Powell.
No stagflation, got that. But the economy is looking pretty good even here in India. I mean, growth has been coming back. Inflation is largely under control and we have a huge event upon us, which is the general elections. How are you feeling about the Indian market now? Do you think this could be another good year for equity market investors?
Well, it's been a very good couple of years already. The Indian market has discounted a tremendous amount of positive news, and looking ahead, the perception of investors is that things are going to get better, and I think that makes a lot of sense. I think maybe there could be some valuation issues, but all in all, the prospects for the Indian economy are quite good, and for the stock market as well. And I think that if we do get a scenario here where the dollar doesn't keep going up, it goes down a little bit, that would help emerging markets in general and India in particular.
Ed, 3 questions. 1, is a July rate cut on the table now? And 2, 50 basis points of rate cuts for this year by the Fed. And 3, you've also said that if the Fed does start to lower interest rates, that could create a melt up on the S&P 500. And then perhaps 6,000 is also on the cards by the end of this year.
Well, anything is possible in these markets, I suppose. Not anything, but that we do have something that's starting to feel very much like a melt up. I've been thinking for over a year that we could get to 5,400 on the S&P 500 by the end of this year. And that was one of the more optimistic outlooks. And here we are only, about 100 points away from getting there. So we could very easily get to 5,400. And yes, I'm looking for 6,000 next year and 6,500 the year after that. In a melt-up scenario, we have to consider the possibility that all of this could happen a lot faster. And in that case, this would be, the analogy would be something like the 1990s, the last half of the 1990s, where the stock market discounts a tremendous amount of good news and then it sets itself up for a meltdown. I'm not rooting for a melt-up. Melt-ups can be a lot of fun and we can make a lot of money, but we have to remember to get out of the top. And then what? Then we have to wait around until the bull market comes back. But at this point, I think the fundamentals are looking quite good. The market's got earnings on its side. Valuation is a bit stretched. But all in all, it's still a bull market.
Ed, here in India, because FIIs have been sort of sellers, big sellers, right, in May and even before this, over the last couple of months, is debate. And now because we are sort of closer to elections and in the election cycle, results are in early June. This debate is on that why are FIIs selling? Is it because they're nervous because of elections, or is it the global cycle a little bit? And of course, also the shift to China, because Chinese markets seem to have bottomed a little bit and seeing a bit of a bounce. Which one of the two sort of appeals to you?
Well, I think that people sometimes sell on the news. So perhaps as the election results become more apparent or easier to divine, to understand, we may have some selling, just kind of a knee-jerk profit taking. Look, I think India's stock market problem is too much of a good thing. It's done extremely well. There are people that have a lot of profits and may want to book them along the way here. But at the end of the day, it's still going to be a matter of fundamentals and valuation. And I think the fundamentals are looking good. The valuation's a bit stretched the way it is in the United States.
Okay, Ed, we'll let you go on that note. Thank you so much for joining us. Appreciate your time here on CNBC TV18. Have a good rest of the week. Well, that is Ed Yardeni, the president at Yardeni Research, about how to approach the markets. Let's take a quick break. Plenty of stocks to talk about on the other side, so don't go anywhere. We'll be back in just a bit. Welcome back to Bazaar Morning Call. Well, looks like it's going to be a good morning of trade. There's a 100-point up move that the GIFT Nifty is suggesting. We've had some fabulous cues from across the globe as well. But let's see, our own market has been full of volatility last few days. So there's definitely still a little bit of caution in the system and resistance at higher levels. But plenty of stocks to talk about. First up, let's find out how Berger Paints did in their numbers. Mangalam is here to tell us more. Mangalam, morning.
Good morning. So it was interesting because, on the volume front, the company reported 14% volumes, and that was the highest that we've seen in all the companies that have reported numbers so far. Value sales have been impacted by about 5% price cuts, and also low value products doing a lot better. So as a result of which, even as the volumes grew 14%, the overall revenue for the company grew just about 3%. The EBITDA was down 5%. Margins came off despite gross margins improving, and the net profit was higher. Why is it that the EBITDA reduced? Because of one, there was a one-off effect of subsidy received in the base quarter that made the base look a lot higher. Secondly, the company's recently started the Sandila plant, so expenses out there have impacted, and additionally, they've also increased their ad spends by about 1% of sales, so that's impacted the EBITDA too. But for the outlook, they believe that, in the near term and in FY25, they would continue to see double-digit volume growth, slightly lower value growth, but the forecast of a good monsoon bodes well for rural demand. However, given the current geopolitical situation, they're, looking at some sort of volatility in raw material prices. So give and take everything and the impending competition along with MSCI, expect the stock to be in the red today.
Okay, in fact, we'll connect with the management of Berger Paints at 9:30 a.m. today on CNBC TV18. Mangalam, thank you very much for that. But M&M reports numbers today, Sonia. But ahead of that, you're tracking XUV 3XO sales. the recent launch.
Yes, you know, the expectation was that the launch will do very well, and it has actually. The kind of bookings that we've got, right, for the XUV 3XO has been fabulous. I mean, the bookings that M&M has got, so we have that stock in focus. They registered over 50,000 bookings within 60 minutes. So 50,000 bookings were closed within 60 minutes of the commencement on the 15th of May. Now, they've already produced 10,000 vehicles. They have a manufacturing capacity of 9,000 per month, which has been set up. And the deliveries of this product or this car will start from the 26th of May, 2024. So it just goes to show that this entire space, the SUV space, has been growing by leaps and bounds. M&M already has #1 market share by revenue in this SUV category and has been sitting at fresh 52-week highs. The company comes out with its earnings today. In fact, not just 52-week high, it's a fresh record high for the stock. It's up 33% in 2024 already. But just to tell you a little bit about what to expect today, it's going to be a mixed bag because although the auto segment volumes are very strong, tractors are under pressure. So this time the tractor segment volumes are down by 20% year on year. But given that the monsoons are coming up, given that, you know, a lot of the rural market recovery is unfolding, perhaps the management commentary on the tractor side could be positive, is what the street is expecting. So let's see. I'm going with green on the stock today.
Cars getting sold out in 30 minutes, right? You said 50,000.
60 minutes,
60
yeah,
minutes.
50,000.
And homes in?
Homes in
3 days.
2 days.
Yeah.
Well, that's the kind of market we are in. Let's go across to Ekta now. Mankind Pharma reported numbers, and the numbers were solid. Ekta is here with details. Morning, Ekta.
Well, yes, it's a domestic play and good set of numbers. Revenue was up 19%. Street was anticipating a 20% growth. The margins came in at better than expectations. It came in at 24.2%. Street was anticipating 22.5%. And the profit was better than expectations as well. The domestic revenue up around 10% year on year. Consumer health, which is basically a lot of their OTC brands, which everyone is very familiar with, was up around 2.6% on a year-on-year basis. There was recovery in Q4, but the entire fiscal was quite subdued for them. What really stood out was exports, up 230% on a year-on-year basis for them, on a low base, but nonetheless did well for them. Now, the board has approved fundraising of around 7,500 crores via QIP. They are planning to increase their investment lending guarantee by around 10,500 crores. They're increasing their borrowing limit to around 12,500 crores of the total company's the total company's capital reserves plus premium, whichever is higher. And on Mankind's interest in BSV, the company says it's speculative. The company regularly looks at inorganic opportunities. So no clarity there, but interesting that they are undergoing some amount of fundraising. More details on the call, which is at 12 p.m. this afternoon.
And it's a large fundraise, right? 7,500 crore rupees. Ekta, thank you very much for that. Let's move on to Dixon Tech, where the numbers look a bit muted. A miss on margins. Upasna?
Company has reported a mixed Q4, slightly below the poll estimate. Revenue stood at 4,658 crores, up by 52% on a Y-on-Y basis, but below the poll estimate of 5,392 crores. Mobile segment drove sales in Q4, and it is important to note that the share of low-margin mobile and EMS segment increased from 46% to 66%, impacting the margins. And margins in this segment are down about 70 basis points at 3.40%. Overall, EBITDA margins were down about 119 basis points and stood at 3.90%, slightly below the poll estimate of 4.03%. PAT stood at 97.3 crores, up almost about 22% on a year-on-year basis, which is a marginal miss as compared to the estimate of 115 crores. The miss on PAT estimate is mainly due to weak demand for TV, lighting and washing machine. Company in its earning conference call has highlighted that it is in the final stages of closure to add one more large global brand in the coming months, and the consolidation of mobile and EMS business will start Q2 FY25 onwards, is what the company has highlighted. It is also said that it is entering into making of display modules for the smartphones.
By the way, you'll hear from the management of Dixon a little later here on the show, and that's going to be an interesting one. But Upasha, thanks very much for that. Vivek is standing by with details on IEX and NLC. Vivek, morning.
Well, good morning. IEX delivered a good set of numbers, but expect the stock to remain range-bound given the fact that there are multiple overhangs in terms of regulatory concerns that persist. Number one is the implementation of market coupling. Number two, there's been a recent CRC staff paper which indicates that there could be some capping as far as variable costs are concerned that could impact sell-side liquidity. But let's have a look at the numbers. Operationally strong set of numbers. Revenues higher by 13.5% on a year-on-year basis. EBITDA higher by 12.3% on a year-on-year basis. Margins are mildly contracting around 80 basis points, but still very strong at 86.2%. Net profit higher by 9.5% on a year-on-year basis. Other income this time around coming in at 28 crore. Now talking about the electricity volumes, again, up quite strong, 15.5%, but this is slightly contracted compared to what some of the other exchanges are saying, indicating that Q4 as well as April, there could have been a slight market share loss that IEX must have faced. DAM prices have actually declined to 5.24 rupees a unit, down almost 12% on a year-on-year basis. Now coming to NLC India, it's a bit of a weak quarter for the company, going with the red on this particular name. A lot of execution delays have happened as far as some key projects are concerned, and that has impacted the operational performance this time around. So revenues are down 31% on a year-on-year basis. Correspondingly, EBITDA down almost 65%, margins at 17% versus 33%, and profitability down almost 86%. One of the key reasons for the profitability going down is also the fact that the other income component this time around has reduced quite significantly at 494 crore versus 720 crore. Now segmental revenues, mining revenue down 11.5%, power revenues down almost 38% on a year-on-year basis.
Okay, thanks a lot for that. Well, Sudarshan is joining. Okay, Vivek, sorry, you have one more. You're going to tell us about NCC as well?
That's right, large infra player, NCC. Now, when you're talking about NCC, whatever the management has guided, they've managed to go ahead and deliver on that. Like other infra players, the key concern over here is the miss as far as margins are concerned, and that could remain an overhang on the stock. But what is the good part as far as the results are concerned? The management went ahead and raised the revenue guidance at the end of Q3. They've gone ahead and marginally managed to beat that as well. Margin guidance, they had given almost a double-digit margin guidance. So EBITDA margin, as per the company, has come in at 8.5%. Revenues higher by 31%. That is quite strong for Q4. EBITDA higher by 18%. Again, quite strong. Margins at 8.5% versus 9.4%, which is the key disappointment. Profitability higher by 18%. Now, talking about the guidance, FY24 order inflow came in at 27,283 crore, which was above the estimate that the company themselves had given of 26,000 crore. A mixed bag, but going with the green, but the margin disappointment is something that could weigh on the performance going forward.
Got that. Thank you very much, Vivek. Let's go across now to Sudarshan for some more earnings. Sudarshan.
Morning, Rima. So I have three stocks. So first we'll start with Honeywell Auto. Going with green, though earnings were mixed, revenue has missed estimates, while EBITDA and margin have come in higher than estimates. Revenue has missed estimates by 4%, but it's higher 12% year-on-year. Margin has come in nearly 200 bips higher at 17.9%, and both margin and profit are at multi-quarter highs. Next is Jindal Stainless. It was a weak Q4. If we talk about headline numbers, EBITDA has fallen 4% and margin was down 70 bips year-on-year, and profit has slipped 30% and revenue was down 3%. But more than headline numbers, what more disappointing was EBITDA per ton. There was a sharp fall. Q4 EBITDA per ton has come in at rupees 14,500 and it's down 27% sequentially and down 33% year-on-year. Last is Titagarh. You would have seen that along with all the rail stocks, even this stock was buzzing off late. Now in the numbers, profit is up 64% and revenue has risen 8% year-on-year, and EBITDA has increased 26% and even margin is up more than 150 bips year-on-year.
Okay, we in fact have the management of Titagarh Rail joining us at 9:50 a.m. later today. Umesh Chaudhary will be with us, so do stay tuned in for that. A big buzzer there. Here's a quick recap though of our top stocks with positive news flow: M&M, Mankind Pharma, Dixon Tech, IEX, NCC, Honeywell Automation and Titagarh Rail. While stocks with negative news flow: Berger Paints, NLC India and Jindal Stainless. But Adani Ports is also in focus. So Sudarshan, you're going to tell us about that?
So along with Q4 results in the early part of this month, company had given the guidance for FY25 and it was a strong guidance. Now company has come out with its outlook for 2030 and it's looking at least very strong. So talking about the outlook, cargo volumes are seen rising to 1,000 million tons from the current level of 500 million tons. That's company is seeing in FY25. So basically, it's expecting it to double in next 5 years. If we talk about logistics revenue and EBITDA, both these are seen growing 7 times by 2030, and port revenue is expected to grow 2x to nearly 51,000 crore. ROCE of all major ports are seen above more than 20%. And if we talk about the headline numbers, revenue, EBITDA and FCF are targeted to grow up to 2.5x by 2030. So it's looking like a strong outlook if we talk about the 5-year plan that company has.
Thank you very much for that. Let's now go across to Manisha for a complete roundup of all the action from the world of commodities. Manisha, hi.
Hi, and thank you so much for that. I'll start with the gold prices because we are back around that $2,400 an ounce, and this is on the back of soft U.S. inflation data that we've seen in past couple of days. Add to that the U.S. retail sales that were also flat for the month of April. And with this now, the investors are pricing in a 72% probability of a rate cut in the month of September. Well, remember, gold has seen a lot of support in sense of Indian buying, China buying, and the global central buying as well. Not just gold, the silver price has also gained up by more than 3% overnight, and we are trading at a 3-year highs right now for this one as well. Silver is up 6% in the past 1 month. Good gains continuing for copper, where we are trading very close to all-time highs that the markets hit yesterday. Well, here as well, it's concerns of insufficient supply to speculative demand that the markets are anticipating in 2024 and 25 that has been supportive. The only area that perhaps has seen a bit of a profit-taking has been the crude oil prices. You have contradicting fundamentals here. On one side, the U.S. inventories have declined, but on the other side, the markets also are concerned about weak demand, especially in the OECD countries, and that seems to be weighing on.
All right, Manisha, thanks very much for that. So that's commodities in action. More on that later. We'll take a break. Deepan Mehta will be joining in from Elixir Equities. We'll talk specific stocks with him on the other side. We'll also, after that, connect with the management of Granules India as we talk about their fourth quarter earnings and FY25 outlook. Stay tuned.
Good morning. It's a very bullish backdrop for Asian markets this morning. The Indian markets too have been recovering. Yesterday, of course, we consolidated flat close on the Nifty at 22,200, but the mid-caps outperformed with the index up close to about 1%. And for the week, we've seen the Nifty rally close to about 2%. Deepan Mehta, director at Elixir Equities, is now with us on the show. Deepan, one of the stocks on our radar today is going to be Dixon Technology. It's been a favorite, especially in this whole Make in India theme, the rise of India emerging as a mobile export hub, manufacturing in India. And the stock Dixon is up 180% in the last 1 year. But the numbers are very tepid. There is a margin miss. And as the contribution of mobile goes up, the margins have been coming under pressure for Dixon. So how would you approach it?
Good morning, Reema. Thank you for having me on your show. Yeah, definitely the numbers were well below, I think, our expectation at least. And more and more the proportion of mobile telephones low is going to be the margin, but the top line is growing pretty well. And of course, you all know about the valuation. These are companies which traded 100 P plus multiples. But the thing is that it keeps getting new contracts, and the PLI benefits still have to accrue to the company. And while the growth momentum is there on the top line basis and the company is executing well when it comes to all the new signings which they have done with global OEMs, I would like to remain invested. It's a very narrow investment theme, and there are very few choices within that space. And also, I think liquidity on the counter is very tight because of loyalty of shareholders and a lot of institutional investments as well. So I would say that although the stock is expensive on a P multiple basis and this quarter has been slightly disappointing, I would still give some more time and remain invested in the company. I think it's got some more legs.
Okay. Deepan, hi, good morning. I wanted your thoughts on M&M, right? The stock is sitting at a record high, but these SUVs continue to sell like hotcakes. I mean, 50,000 bookings in in 60 minutes is what the new SUV saw. But how much of all of this good news do you think is already in the price? Because to be honest, their tractor business is still struggling quite a bit, given the kind of macro environment. So what do you do now with the stock?
Yeah, good morning. I think the stock has got a lot of room to move up. And I place my positive opinion on the fact that we are expecting a very good monsoon. And of course, tractors business should do significantly better once the monsoon is better. At the same time, a lot of the sales of the SUVs also comes from the rural areas. Not the high end, but the medium and low end SUVs are sold in a lot of rural areas. And at some point of time, I think, if I recollect, 60-70% of revenues are linked to rural economy. So if rural economy is going to do well, I think M&M's next 2-3 quarters also will be exceptionally good. Valuations are reasonable, of course, higher compared to historic multiples. But still, I think the way they are able to generate new and successful new models, and the fact that they have also, it's a more cost-conscious company with a lot of focus on return on investment as well. So I think all of these merit a higher P multiple. And there's, of course, the export potential, which they have just about scratched the surface. So keeping the entire view in mind, we're quite positive on the stock, and it could be a real outperformer in the auto space.
Got that. Deepan, hi. Good morning. Just a quick word on Mankind, if you have any thoughts. I mean, it's a local pharma giant, solid numbers, strong distribution, 24%. I mean, big improvement in margins as well. Do you track this one? Any thoughts?
Yeah, good morning, Prashant. It's been on my watch list to buy since it got listed, because I'm very impressed with the business model and the way they have scaled up the company within such a short period of time. And there are a lot of innovation when it comes to marketing of pharmaceutical products, going to tier 2, tier 3, and pricing their branded generics lower than what is available in the market. Definitely numbers since listing have been exceptionally good. But you have a look at the export figure, especially exports to US. That's what's been driving the bottom line, I think. And the investor presentation keeps saying that these are one-off opportunities. And that's what kind of, puts a red flag in my mind that, what if these one-off opportunities were not to repeat in the near future, next 2-3 quarters or so? Then I think, you could have these kind of growth rates may not be sustainable. But nonetheless, I think, it's a great company. And I'm looking for the right price point, a little bit of margin of safety to perhaps make an investment in Mankind. It's a unique company. And I would say a structural growth story, considering that spending on healthcare and branded generic products is only going to rise over the next few years.
And by the way, we reported that Mankind, and this is, of course, we'll have to confirm that Mankind is looking to buy, looking at the acquisition, Bharat Serum and Vaccines. Now, the seller is looking at a 2 billion ticket price. But we'll see. And we'll probably have an opportunity to put those questions to the management as well. Deepan, just one more space, right? The capital goods space, Siemens, if you can have these intradays up, Siemens was up big time, CG Power was up big time, Thermax was up 8-9%, you had Hitachi Energy, which was up about 7%, even industrial gases company, Linde India, KEC, Sterling Wilson Solar. This is the spectrum across capital goods and equipment makers. What do you like here, and what's happening in your opinion?
No, I think that the capex upcycle is well and strong, and from that point of view, these companies are making showing great performance because of bulging order book position. Also, I think the new orders which they're executing just now are at very high operating profit. I would say better operating profit margins. Operating leverages also are coming into play over here, and they are sitting on good order book position, providing them earning visibility. But end of the day, these are cyclical businesses. And if you study their 10, 15, 20-year growth story, then there have been multiple periods where 3-4 years growth goes nowhere. There's negative growth as well. So keeping in mind the cyclicality and that we are in an upcycle kind of a situation, I don't think the present P multiples are kind of justified. I think the likes of ABB, Siemens, Honeywell go at 100+ P multiple. Even local companies like CG Power and some of the other companies you named, they're also going at 40, 35, 40 P multiple on a trailing 12-month basis. So from that point of view, I just want to be a bit cautious. And maybe at a correction, you could look at buying into these companies if they're correcting by 15-20% and are available at reasonable P multiples, because these are not structural growth stories which can continuously grow at 15-20% for next 5, 10, 15 years, like say a retail company or some of the consumption-oriented businesses. So when one cannot pay such a high P multiple for a business which has got a lot of cyclicality within its operations.
Okay, Deepan, I don't know if you track Granules or not, but we have the management joining in, so request you to listen in and then perhaps give us your view. The company reported a very subdued quarterly performance. It saw a sharp decline in its API and pharma formulation intermediate segment. Margins was in line with the guidance, but the net debt also declined. But overall, the business has seen a bit of a deterioration. To discuss more on this, we have Krishna Prasad Chigurupatti, who's the Chairman and Managing Director at Granules India, who joins in now. Mr. Chigurupatti, always nice speaking to you, and thank you for joining us early this morning. Can you tell us, there has been a sluggish performance across most of your verticals, especially and across most geographies as well. Can you give us a sense of whether FY25 will continue to be to see this kind of performance, and what is the kind of growth that you're looking at across segments in FY25?
Good morning. First of all, let me start off with the positivity rather than the negativity. Every segment of the business, which has been our focus, we've been trying to convert all the APIs and PFIs into FTs. That has grown very well. It has grown by 41% year on year. And in Q4, it contributed to 74% of our revenues. Now, regarding the subdued performance of APIs and PFIs, this is driven mostly by paracetamol. Paracetamol, some of our very important customers who are brand leaders have excess inventories. They're trying to correct those inventories. It's been going on for a long while, and we expect that to correct in the next few quarters. And also, there has been an excess capacity buildup in the world after COVID time, and that has also led to a lot of price erosion. And prices, in fact, have become half of what they were last year. And this has really hit us. And the same thing with PFIs. Most of the PFIs that got hit were PFIs of paracetamol. And regarding the geographies, US, we did well on formulations. That's why there was no degrowth. There was, in fact, a very decent growth there. And when you come to Europe and Latin America and rest of the world, the business there was driven mostly by paracetamol. That had taken a hit, and hence the subdued performance in these markets. And going
the
forward,
paracetamol market, if you can just quantify for me, what has the price erosion been up until now in Q4? And what is the expectation on prices in FY25? If you can just give us some numbers.
Just to give you an example, last year the paracetamol was selling at more than 600 rupees. And this year it's down to about 280 rupees. Of course, the raw material prices have come down too, but not in the same proportion. The margins have taken a very, very big hit here. And going forward, this is the lowest that it can get to. And in fact, we have taken a call not to really compete at these prices in some of the rest of the world markets. But people are desperate. But there is a time how long they can continue. We expect quarter on quarter, there will be a steady increase. But next year, we can see the real normalcy. That's my feeling.
So what's your overall dependence on the paracetamol market? How much does it contribute to your top line and EBITDA?
It's less than 25%.
To the top line and EBITDA?
That's right. EBITDA is actually this year, this quarter, it's a lot less.
Yes.
But top, yes.
Got it. And when you've given a guidance of, I think, EBITDA margins of 22 to 23% for FY25, now this is an increase compared to the 19% that you have delivered in FY24. So you're building in a margin increase to deliver 22 to 23%. What will drive that?
No, it says 23% for the year. It's not an increase of 23%.
No, exactly, sir.
Yeah. So the driver is going to be mainly the formulations, the new launches. The existing products have taken increased market share. And also we had many launches last year, which have also become market leaders. In fact, today, if you see in the United States, in the formulation front, 7 of our products, out of which only 2 are the legacy products, 5 are new products, are already market leaders, where we enjoy shares of more than 50% and the highest market share in the market. This is again increasing. And also we have 14 new launches coming up in this year. We expect those things also to contribute. What has been launched last year, the market share will grow, and the new launches also will contribute to extra revenues and extra margins. And also, so go ahead, sorry.
No, go ahead. Finish your point, sir.
The US manufactured products, we concentrate a lot on CNS products and also C2s, mostly in the ADHD areas. And in fact, we have a very good market position on these products. We expect those products also to contribute. More launches are happening in this area.
Okay. And is there any guidance, sir, on the top line? FY24 was flat, understandably because of what happened with the paracetamol market. But now that you're penciling in some quarter-on-quarter recovery in paracetamol, can we expect a high single-digit kind of revenue growth in FY25? Can it push to double-digit?
Definitely, the high single digit is no problem. Definitely, low single digits also no problem. But our aim is to do better. Let us see where we end up.
Okay. Just a couple of quick questions if I can squeeze in. Your debt was down about 10% quarter-on-quarter at about 840 crores. Any plans for further debt reduction?
No, we are not very keen on debt reduction. All we want to do is maintain a healthy leverage. We always said that we will maintain a leverage of less than 1% debt-EBITDA ratio, less than 1. And that's what we intend to keep up. And we have a lot of growth plans. So we are being very responsible and frugal in our growth. But we don't want to be too conservative and trying to bring debt down and not invest into growth. So we will maintain our debt-EBITDA at less than 1.
Okay, debt-EBITDA at less than 1. Any structural changes in the US generics business? Are you seeing lesser competition there?
Competition is always there. It all depends on how effective you are, what is the cost efficiency, and we try to be cost leaders. It's still a long time before the competition goes away. I think competition is healthy too. That shows your efficiency.
Okay, so we'll let you go on that note. We've run out of time, but not out of questions. But we'll have this discussion at a later date once again. Thank you, as always, for joining in. Let's take a quick break. On the other side, Mitesh Thakur, Sudarshan Sukhani will join in for some technical trades. Stay tuned.
Welcome back. Prepare for a good trading session. The markets across the world have turned to risk, and the SGX Nifty 2 is suggesting a positive start, steady still, with a 100-point gain. Mitesh and Sudarshan are with us on the show. Gentlemen, good morning. Sudarshan, starting with you. After a gap-up opening, how would you approach the index?
Yeah, good morning. For the last 2 days, I've been saying we should be buyers. Yesterday, I said we should buy and carry forward positions. Now, assuming you still don't have a position in the Nifty and a long position, the gap up gives you an opportunity to re-enter on a minor intraday dip. This is a rally that's not just intraday. I expect it to have some movement till it reaches wherever it wants to. So stay long in the Nifty and the Bank Nifty both. After a gap up, look for a minor dip only and then enter.
Long on the Nifty and the Bank Nifty both. Mitesh, hi, good morning. How about you? Do you also concur with the view that staying long is the best thing to do now?
Good morning. So yesterday, I think, we went long and the market just turned sideways. But I think that indicator setup on the hourly chart remains positive. I think today we will start about 22,250 on the spot because the SGX is showing about 9,500 kind of gap up. And I think we'll head towards the target areas, which I was looking at around 22,350 to about 22,370. That is the first target area, second target around 22,500. So maintain your long positions. The only thing I would want to do is with the gap up today, you might want to trail your stop to just about 10 points below 22,250, which is the hourly pivot.
Okay. Let's get to the stock recommendations then for the day. Mitesh, what would you suggest?
So I have all buy calls today. MFSL after a correction seems to be reversing. So buy here with the stop at 980. Look for targets of around 1,050. Power Grid is a buy with a stop below 310 for a target of 325. BEL is a buy with a stop at 230 for targets of 242. And Bharat Dynamics, that's a cash stock. Buy here with a stop below 1950 for targets of 2100.
BEL, BDL, there is Defense, Power Grid, a lot in the capital goods kind of space, right? And Motilal Oswal Financial Services. Gentlemen, morning. Sudarshan, what are your trades?
Well, almost similar. Voltas is a buy. It's coming out of, hopefully it will come out of a deep correction. Buy with a stop under 1250. A new name is Metropolis Health, where I think a breakout is now coming about. Buy with a stop under 1704. Power Grid again. Power Grid is a buy with a stop under 296. And finally, Bank of Baroda from the PSU section. Actually, you could buy any of the 3-4 PSU banks, but Bank of Baroda is a buy with a stop under 255.
Okay, thanks for that. Well, Chandan Taparia is also joining in. Chandan, hi, good morning. Tell us about the derivatives market. What is the trend looking like, and what are the individual stocks to look at today?
Good morning, Sonia. Thanks for having me. So we have seen some recovery from the lower levels, but follow-up is missing in the market. The concern is that India, which is not cooling down, the VIX is now hovering near 20 zone. So as of now, the index has taken support near 21,900 zone, but follow-up is required about 22,222. If Nifty manages to hold 22,222, then we can see a recovery towards 22,500, 22,600 zone. So 22,222 is going to be a decisive level in the market. Now, talking about the Bank Nifty index, we witnessed some recovery, but again, some range-bound bias is clearly visible. Bank Nifty needs to hold 47,770 zone. Then only the up move could be seen towards 48,250 to 48,500 zone. So I believe that both the indices, Nifty and Bank Nifty, are likely to be in a broader range. We require volatility index to cool down. Then only the smoother, more comfortable bullish stance could be back in the market. Now, looking at the stock-wise, we have seen good stock-specific action in the market. First, that is buy on Cummins. We have seen buying interest in most of the capital goods name. We have positive stance in counter like Siemens, ABB, BHEL, Cummins. And here we are recommending to buy on Cummins. The stock has been making higher top, higher bottom. It has given a fresh breakout. We have seen built up of long position. So one can buy with support of 35.90, and the stock has potential to move to us 38.50 level. Second trading idea, that is buy on Indigo. The stock is all set to fly high. We have seen decent built up of long positions. Even the derivatives data indicates the put writing activity. We have seen positive price action, and one can buy with support of 42.20, and Indigo can head to us 44.50 level. Last trading idea, that is buy on PFC. Stock has bottomed out with support at key moving averages. We may see some short covering activity, so one can buy with support of 428, and PFC can potential to head to us 458 levels.
Okay, Chandan, thank you very much for that. We'll slip into a break. We'll come back with the pre-opening. We'll also be joining us will be Prabha Narasimhan of Colgate-Palmolive to talk about the Q4 earnings. Stay tuned. Welcome back. Prepare for a good trading session. The markets across the world have turned to risk, and the SGX Nifty 2 is suggesting a positive start, steady still, with a 100-point gain. Mitesh and Sudarshan are with us on the show. Gentlemen, good morning. Sudarshan, starting with you. After a gap-up opening, how would you approach the index?
Yeah, good morning. For the last 2 days, I've been saying we should be buyers. Yesterday, I said we should buy and carry forward positions. Now, assuming you still don't have a position in the Nifty and a long position, the gap up gives you an opportunity to re-enter on a minor intraday dip. This is a rally that's not just intraday. I expect it to have some movement till it reaches wherever it wants to. So stay long in the Nifty and the Bank Nifty both. After a gap up, look for a minor dip only and then enter.
Long on the Nifty and the Bank Nifty both. Mitesh, hi, good morning. How about you? Do you also concur with the view that staying long is the best thing to do now?
Good morning. So yesterday, I think, we went long and the market just turned sideways. But I think that indicator setup on the hourly chart remains positive. I think today we will start about 22,250 on the spot because the SGX is showing about 9,500 kind of gap up. And I think we'll head towards the target areas, which I was looking at around 22,350 to about 22,370. That is the first target area. Second target around 22,500. So maintain your long positions. The only thing I would want to do is with the gap up today, you might want to trail your stop to just about 10 points below 22,250, which is the hourly pivot.
Okay. Let's get to the stock recommendations then for the day. Mitesh, what would you suggest?
So I have all buy calls today. MFSL after a correction seems to be reversing. So buy here with the stop at 980. Look for targets of around 1,050. Power Grid is a buy with a stop below 310 for a target of 325. BEL is a buy with a stop at 230 for targets of 242. And Bharat Dynamics, that's a cash stock, buy here with a stop below 1950 for targets of 2100.
BEL, BDL, There is defense, power grid, a lot in the capital goods kind of space, right? And Motilal also financial services. Gentlemen, morning. Sudarshan, what are your trades?
Well, almost similar. Voltas is a buy. It's coming out of, hopefully it will come out of a deep correction. Buy with a stop under 1250. A new name is Metropolis Health, where I think a breakout is now coming about. Buy with a stop under 1704. Power Grid again. Power Grid is a buy with a stop under 296. And finally, Bank of Baroda from the PSU section. Actually, you could buy any of the 3-4 PSU banks, but Bank of Baroda is a buy with a stop under 255.
Okay, thanks for that. Well, Chandan Taparia is also joining in. Chandan, hi, good morning. Tell us about the derivatives market. What is the trend looking like, and what are the individual stocks to look at today?
Good morning, Sonia. Thanks for having me. So we have seen some recovery from the lower levels, but follow-up is missing in the market. The concern is that India, which is not cooling down, the VIX is now hovering near 20 zone. So as of now, the index has taken support near 21,900 zone, but follow-up is required about 22,222. If Nifty manages to hold 22,222, then we can see a recovery towards 22,500, 22,600 zone. So 22,222 is going to be a decisive level in the market. Now, talking about the Bank Nifty index, we witnessed some recovery, but again, some range-bound bias is clearly visible. Bank Nifty needs to hold 47,770 zone. Then only the up move could be seen towards 48,250 to 48,500 zone. So I believe that both the indices, Nifty and Bank Nifty, are likely to be in a broader range. We require volatility index to cool down. Then only the smoother, more comfortable bullish stance could be back in the market. Now, looking at the stock wise, we have seen good stock-specific action in the market. First, that is buy on Cummins. We have seen buying interest in most of the capital goods name. We have positive stance in counter like Siemens, ABB, BHEL, Cummins. And here we are recommending to buy on Cummins. The stock has been making higher top, higher bottom. It has given a fresh breakout. We have seen built up of long position. So one can buy with support of 35.90. And the stock has potential to move towards 38.50 level. Second trading idea, that is buy on Indigo. The stock is all set to fly high. We have seen decent built up of long positions. Even the derivatives data indicates the put writing activity. We have seen positive price action, and one can buy with support of 42.20, and Indigo can head towards 44.50 level. Last trading idea, that is buy on PFC. Stock has bottomed out with support at key moving averages. We may see some short covering activity, so one can buy with support of 428, and PFC can potential to head towards 458 levels.
Okay, Chandan, thank you very much for that. We'll slip into a break. We'll come back with the pre-opening. We'll also be joining us will be Prabha Narasimhan of Colgate Palmolive to talk about the Q4 earnings. Stay tuned.
Welcome back. We have a couple of minutes before the pre-opening rates kick in. You're watching us live from the CNBC-TV18 Motilal Oswal studio. Before the markets open for the day, Dipan Mehta is still with us. So let's get some calls out of the way. Dipan, in just a bit, we're going to, speak to the management of Colgate. So we'll try and understand a little more about rural demand. But overall, the sense we're getting from most corporates this time is that rural demand has come back. Not in a big way, but there are green shoots. So whether it's HUL, Dabur, Colgate, Hero Motocorp, all speaking about that. From this entire pack, what would your, pick of the pack be?
See, when you talk about rural growth rates and a good monsoon, kind of a forgotten sector is agrochemicals. And if you have a good monsoon, then towards the end of the monsoon, these agrochemical companies start to do really well. Companies like PI Industries, Dhanuka, Rallies, perhaps even a UPL. So that particular investment theme, I'd like to play through these agrochemical companies. Fertilizer companies also should do exceptionally well. And of course, tractor companies also will benefit. When it comes to FMCG, even in the rural areas, these products have achieved a high degree of maturity. See, back 5-10 years ago, the real play in rural was expansion of distribution networks, and that created great value for all the FMCG companies. But now I think FMCG products have reached almost every village, and further gains from expanding distribution are not visible. Also, base effect has come into play. Rural anyway, a high degree of maturity has come in the FMCG products. So from that point of view, FMCG is unable to generate that kind of a 8-10% even type of volume growth. So I don't find it very attractive. But yes, I think a cyclical upswing in the rural economy could throw up very interesting new investment ideas.
Dipan, what about something like Indus Stars? Yesterday in Bharti's conference call, while they did reiterate the need for tariff hikes, they also said that FY24 was a peak capex year, and capex for Bharti will come down in the subsequent year in FY25, which means that if they spend less, that means more, less business for a company like Indus Stars. So would that be a big negative considering the stock is up 70% year to date?
My Indus Towers is an annuity business, and even incremental additions to the towers, keeps on adding to their bottom line. And, the biggest hangover in Indus Towers was the dues which they were supposed to get from Vodafone Idea. And now I think the probability of realizing those dues certainly has improved significantly. And Vodafone Idea itself is going in for expansion and upgradation. So that's an opportunity for Indus Towers as well. And there's a fair degree of consolidation also within the tower space. Valuations are reasonable. Business throws out a lot of cash, and management has been distributing it pretty well. And on the whole, I think that it's a good business which can give steady revenues, a kind of a defensive play, if you may ask. And even once the overall health of the telecom industry improves, I think some amount of pricing power also Indus Towers will get, and they may be able to get higher realizations as well. Of course, there's lower lower fuel charges also, which may benefit the company. So looking at the overall picture, I'm remaining invested in Indus Towers as a measure of disclosure. We and our clients are invested. And I think that the company can deliver outperforming returns over the next 2-3 quarters or so at least.
There is this call from Kotak Equities, and it's pretty interesting. They've not changed their rating or anything. They're a sell. They say price target is 10 rupees. But they're saying that there will be a price increase. They're expecting a 20% tariff hike after general elections, and then a 15% tariff hike from December 2025. And they say risk-reward actually for Vodafone Idea, the skew remains very high. Bull case is 23. And bear case is 7. So that's the way they framed this. But Colgate reported a good set of numbers for the fourth quarter. Margins have hit an all-time high. Revenue and profits also saw healthy growth. My colleague Mangalam spoke with the management. Prabha Narasimhan, Managing Director and CEO at Colgate. Listen in.
From a consumption lens in the country, I think I'm going to restrict my comments largely to what we're seeing in the oral care category. A couple of things that we're seeing. Firstly, we had discussed in the past the need for companies like us, or particularly us, actually to drive consumption of the toothpaste category. And that's something that we've started the journey on. I'm sure we'll talk about it shortly. But the second thing that we are seeing that all companies are calling out, including us, and we'd actually called it out, I think, towards the beginning of second half of last year, was some early green shoots in recovery in rural consumption. We're now seeing more of that as we go into this quarter, and our rural growths have actually been about 200 basis points ahead of our urban growths for the first time, ahead of urban growths in the last little while. So that's really heartening to see and augurs well, I think, for the remaining quarters. In as much as urban is concerned, premiumization continues apace. There's a lot of headroom opportunity in oral care for premiumization, so it's a good thing that it continues to pick up speed. And urban consumption, like I said, we've done some concerted efforts. Obviously, too early to measure results of those efforts, but the right thing to do.
All right. I was listening to your conference call and you did say that pricing from now appears a little more moderate in terms of a tool for growth going forward. Instead, you expect the growth to come in from volumes as well as the mix premiumization that you just spoke about. Could you give us a sense of what are you gunning for in terms of category growing in FY25 and how much of that would be something that Colgate would do, maybe better than category or at par if at all?
So I think, firstly, as we look towards growth, there are three parts to growth, like you've said. The first part is volume growth. The second part is mixed growth. Then the third part is pricing growth. And on pricing growth, I think as we are seeing inflation moderate, we do expect that price increases that the category will get, and therefore we will get as well, will be more moderate. That then needs to be made up or more than made up actually by mix and volume. And our effort will be to actually get a balanced view of all of these three. As pricing moderates a little bit, mix picks up a little bit, volume picks up a little bit, still allowing us to record competitive growths, but with a more balanced view between these three.
So if one was to assume a double-digit growth for, you all in FY25, how would you balance that out in terms of price, mix and volume?
So I think if I was to give you just ranges, Mangalam, rather than the specifics, because honestly, we don't have, we don't measure the specifics or we don't communicate the specifics. I think pricing probably in the range of 3 to 5% would be the range of pricing that we could look at, and the remaining coming from mix and volume.
Dabur reported a 22% jump in their oral care. HUL reported a double-digit growth in their oral care business as well. So were you better than the market this time around? What explains their outperformance?
So I think, like with all things, I know we report results on a quarterly basis and we have conversations on a quarterly basis, but I firmly believe that the way to run organizations is really to look at them over a longer term basis, and the joy or the not joy, as the case may be, of being in the oral care category is that most of the large players are listed. We do get to see what is their performance over in the immediate quarter, as well as what has been the more medium term performance. And as I look at this, I'm actually feeling quite happy with our results. I think we're in a good place. We have a very well laid out strategy. We're executing to that strategy. The strategy is working for us to get to competitive growth. We're doing really well on bottom line as well, and therefore are really fit for investment as we go into the rest of this year or into the new financial year. So altogether, I'm actually in a good place.
All right. And what's also in a good place is your margins. I mean, 35.7% is the record margins that the company has posted. Though I'm not sure whether the street is happy about them having hit a record high, or they're unhappy about, you not having invested as much as they thought they would. Or maybe they're wondering whether there is any more upside to margins here. I mean, just want your thoughts on where margins would be going forward and whether one should look at this 35.7 as a one-off.
So I think, firstly, I want to comment on the fact that good margins actually is a demonstration of a very, very strong brand and a P&L that is exceedingly robust. So actually, from a perspective of margins having gone up, I think it's a good thing that margins have gone up while top line has gone up as well. And it helps us, therefore, to have the money and the fuel for investment. Having said that, this margin has gone up despite the fact that our advertising expenditure for the year has grown faster than our top line growth. We've increased advertising expenditure by about 20%. Colgate is, if I'm not mistaken, the most advertised FMCG brand, or at least certainly in the top 3 FMCG brands in terms of advertising. And the amount of money that we're spending now is in the ballpark of between 750 to 800 crores on advertising, which is a sizable amount of expenditure behind building a brand. The immediate quarter margins are a function of 2 or 3 things. They're obviously a function of a very, very strong, what we call funding the growth program, which is really a program that looks at costs up and down our value chain across every single line and is ruthless about taking out every non-value adding cost. We have a great rhythm to this, and what we are finding is that we are able to get between 4 to 6% of net sales or 4 to 6% of turnover of non-value adding costs that we can remove without compromising on product quality. And in fact, we're then able to invest back some of this into better product quality and into the increased advertising that you see. So from my perspective, actually margin is a sign of great strength. It puts us in a position to be able to invest even more to take this category and to drive the strategic priorities that we have.
So are you comfortable with the margins that you have currently staying at this level, or you would like them?
Sorry to interrupt, but I think the gross margins that we are at are probably at ballpark the levels that we would like to be at, give or take, marginal movements on either side. That's kind of the space in which we would like to operate, and that's probably the space at which we will stay.
All right. What about Palmolive? We've seen a lot of new launches, but I mean, too early to call any sort of growth pattern out here yet. What are you factoring in? 2x the portfolio growth in FY25?
So I think from a Palmolive perspective, firstly, I think it's been a series of structured changes that we have done on the brand. The first, of course, is for us to focus on where we believe we have the right to win. And we believe we have the right to win in body wash and hand wash. We have upgraded our formulations towards the back end of last year. Beginning of this year, we've launched 3 new variants on body wash. Just with the improved product and the new variants, we were already seeing a share uptick in modern trade and e-commerce. We do expect that these channels of the future will continue to grow, both modern trade as well as e-commerce, and that the mass media will help as well. The television campaign is supported by influencer, by digital, and by shopper as well. And I must confess, I'd be disappointed if we didn't end up at least around 3x of our average growths on Palmolive.
Prabha, so just to sum things up, if you were targeting double-digit revenue growth in FY25, you would see no more than 3 to 5% coming in from price. The rest would come from volume and mix. How about 30 to 34% in terms of margins as a band, with the gross margins staying where they are and Palmolive growing 3x the entire portfolio? Would that sum your targets up for the next year?
So I think I tend not to give specific guidances on, top line growth. But in terms of the shape of the P&L, I think that is what we would be looking for, which is accelerated top line growth supported by, gross margins staying in the ballpark of where they are at, and for us to invest to make sure that we have enough ammunition to deliver the competitive growth that we're looking to deliver.
Looking at accelerated growth, maintaining margin. That's a very interesting interview coming in with Colgate also saying that the rural consumption was 200 basis points more than urban, echoing what Dabur said. Dabur 2 weeks back said rural is growing faster than urban by 400 basis points. And for Colgate, it was about 200 basis points. It's 9:10. Good time then to get in the 9:10 call. Sudarshan, what do you have for us?
Buy Power Grid with a stop under 296.
And Mitesh, what about you?
I will choose a cash stock, that's Bharat Dynamics, VDL, buy with a stop below 1950 for targets of 2100.
Okay, one stock we'll be watching from yesterday is actually Bharti Airtel. Now, Bharti Airtel ended up with a gain of 2% yesterday, and it inched up in the last 1 hour while the investor call was ongoing. The investor call started at 2:30 p.m. And here, Gopal Vittal, the CEO of Bharti Airtel, batted for a tariff repair. He said the tariffs are at absurdly low levels compared to anywhere in the world. Tariff repair is needed in the industry. They will need substantial tariff repair. And even if ARPUs hit 300 rupees, they will still be the lowest amongst the world. That said, he didn't comment on the timing of a tariff hike, the quantum of a tariff hike, and if at all, a potential tariff hike is coming. But brokerages are reading this positively. So JP Morgan upgraded Bharti Airtel to an overweight, raised the target price to 1500. They're saying the industry focus is now changing away from gaining market share to monetizing, increasing, improving the return ratio. So the focus of the industry is now changing away from land grab to monetization. Kotak too has raised the target price on Bharti Airtel to 1410. They're saying that yes, Bharti Airtel has significantly outperformed the industry and it's now trading at valuations higher than its long-term valuation. But even now, the risk-reward remains favorable, which is why they've upped the target price on Bharti Airtel to 1400. On Vodafone Idea, Kotak says they've reinstated coverage with a sell. The target price is at 10 rupees. But they say the risk-reward skew is high for Vodafone Idea. So the bull case target price is 23, while the bear case target price is only 7. In terms of tariffs, they're expecting a 20% tariff hike after the general elections, that's sometime this year. And in December of 2025, which means 18 months from now, after the first tariff hike, they're expecting another 15% tariff hike, and that expectation is up from 10% earlier. So building more tariff hikes in the next 18 months.
Okay, well, the other stock we're looking at this morning is Honeywell Automation. So Sudarshan is here to tell us why we should be watching that one. Sudarshan, good morning.
Good morning, Sonia. So Honeywell Auto has reported earnings which were mixed, and the stock is opening with like minor cuts, I would say cuts of nearly 3%. Talking about numbers, revenue has missed estimates while EBITDA and margin were above estimates. Revenue has missed estimates by 4% but was up 12% year on year, and margin is up nearly 200 bips at 17.9%. Talking about the brokerage stake, Nomura has a buy rating and it has raised target to 53,600 from 46,100 per share. It says revival in realty, healthcare and hospitality to push demand for building automation, and it has raised P multiple to 60 times from 55 times on sectoral tailwinds, and expects margin to recover to 15.6% by FY26 from 13.8% in FY24. So overall, views are positive, but the stock is opening with in the red.
So thanks very much for that. Look at the pre-open session, right? 118 on the Nifty and 350 on the Sensex. Dixon is going to be the next one, which is in focus. We have the management joining us later, but the numbers with Upasana. Upasana, morning.
Company reported a mixed Q4, slightly below the poll estimate. Revenue stood at 4,658 crores with an uptick of 52% on a YoY basis, slightly below the poll estimate of 5,392 crores. Mobile segment drove sales in Q4, and it is important to note that the share of low margin mobile and EMS segment increased from 46% to 66%, impacting the margins. Overall, EBITDA margins were down about 119 basis points to 3.9%, slightly below the poll estimate of 4.03%. PAT stood at 97.3 crores with an uptick of 22% on a YoY basis, which is a marginal miss as compared to the estimate of 115 crores. In terms of brokerages, Goldman Sachs has given a sell rating with a target price of 5,910 rupees. It says from here, market will keenly watch the ramp up in all segments, particularly mobiles, where upside surprises seems unlikely on steep volume ramp up that the management has guided for. While CLSA has given a outperform rating with a target price of 9,000 per share, it says that it sees further growth optionality from new initiatives like backward integration, industrial EMS and faster ramp up of laptops and tablets that the management has guided for.
All right, Upasana, thanks very much for that. And as I said, the management chat coming up a little bit from now. The market opening is a few seconds away. It's going to be a solid start. The Nifty is indicating a 100-plus point gap up. The Sensex is indicating a 350-point gap up. Now, you basically start above the 22,300 level. And the 20-day moving average is not very far away. I mean, I think about 22,330 or so is where that is at. Sustaining above that, closing above that, I mean, I think that will be the first kind of step to putting some of this corrective phase behind us. We'll look at, of course, the indices and then stocks. What do we have? On the Nifty, we are starting at 22,288. On the Sensex, we are starting at 73,300. It's 86-87 point higher start on the Nifty. Almost three-digit gain now. Mid-cap index is up 0.5%, 273 on the mid-cap index. And I think you've got the small-cap index, which is also starting about 0.5% higher. So those are indices, but as we've seen, it's been, groups of stocks over the last couple of days which have done well. Yesterday it was capital goods. Before that, it was PSUs, metals. So let's get it with stocks. Sonia's got that with her. Sonia.
Well, thanks a lot for that. As you rightly pointed out, it's a good opening for the market, right? Almost 90 points higher now on the index. But I'm going to take it straight to individual stocks. M&M really is the stock on our radar. We heard about the XUV 3XO seeing over 50,000 bookings in 60 minutes. So look at M&M now, fresh record high, up almost about 1% and really taking it away, 2,300 on M&M, big move over there. Adani Ports is the other one, very strong commentary coming in, up almost about 1%. They say that cargo volumes are targeted to reach 1,000 million tons in 2030 and the port's ROC is expected to be over 20%. So just keep that on your radar. Bharti Airtel is the other one. The India business has been very strong and Rima was telling us that a lot of brokerages have raised their target price on the stock. Kotak has raised its target price to 1,410, so big upside to the current market price here. So keep an eye on Bharti Airtel. IEX is the other one. Overall electricity volumes are up 15.5%. The EBITDA is up 12.5%. And look at the stock charging away now, 3.5% higher. Apart from that, there's NCC, which reported a decent set of numbers. The stock is up about 3%. EBITDA went up 18%. Revenues rose 31%. So just keep tracking that one. Then there's LIC Housing Finance. The disbursement growth was pretty good, almost 14%. AUMs have risen 4.5%. So looking good on LIC Housing Finance. Let's move to Dixon Technologies. The headline numbers were a miss, but the mobile business growth has been healthy and the street likes that. 8,200 now on Dixon Tech has been a huge mover lately. So the stock is piling on the gains, up about 2%. Honeywell Auto as well, the EBITDA and margins were above estimates. The margins actually saw almost a 200 basis points rise. But for now, the stock is coming in for some profit taking, so down about 4%. Titagarh Wagons, the EBITDA has gone up almost 26%. Margins above estimates and the street likes that. 6% higher. More with the management coming up in a bit, so stay tuned for that. Mankind Pharma, the Q4 numbers were better than estimated. Margins higher as well at 24%, so looking good. CMS Info, EBITDA up almost about 9%, revenue growth of almost 25%. Then we take it to some of the numbers that came in post-market hours yesterday. Berger Paints, overall almost 14% volume growth is what Berger Paints saw. So keep an eye out on that. Yesterday's listing, Aadhar Housing, it was a subdued listing, but HNI investors, Akash Bhansali bought almost 45 lakh shares on day one. And as we told you in pre-opening as well, Aadhar Housing is now the cheapest amongst the housing finance stocks. So just look at the move there. Day one was not great, but day two is seeing a big move on the stock. Overall, since it's the fag end of the earnings season, so many stocks coming out with numbers, so we're tracking that. But the main focus area is here. Almost a century now on the Nifty, looking pretty good. And this is the main area to focus on. 1,800 stocks on the advancing side. So clearly, the market breadth is improving, which is a great thing. Back to you.
Well, IT is also doing pretty well today. Pull up the Nifty IT because names like Tech Mahindra, that's up 1.7%, LTI Mindtree, HCL Tech, Wipro, across the board, the large caps are showing you pretty healthy gains. So IT is leading from the front, with the Nifty IT index also showing you a rally of close to about 1% right now. Outside of the index, it's Apollo Tyres which catches your attention. It's a 5.5% gain on Apollo Tyres, and there have been a lot of upgrades coming through on Apollo Tyres. So Nomura has upgraded it to a neutral. They're saying the current valuation does not look very expensive. And the other one is JP Morgan, which has upgraded Apollo Tyres to an overweight and raised the target price to 550 because the company continues to demonstrate its commitment towards balance sheet deleveraging. So Apollo Tyres is a stock which is on fire today. Came out with numbers though 2 days back. On the way down, keep your eye on Reddington. The stock has slipped nearly 5%. A disappointing set of numbers. The company's margins have come under pressure. EBITDA margins in the current quarter are at 2%, which compares with 2.2% sequentially and 2.5% a year ago. So Reddington, is losing ground. But other than that, it's a pretty good-looking screen, and at least the Nifty is managing to hold on to its gains, and the advanced decline ratio is very strong.
Well, 90 points higher, right? And so this is as good as they come, especially in a market phase that we find ourselves in. I think we've sort of outlined a bulk of the long list of stocks there, which are moving. Aadhar Housing, by the way, is the #1 volume-led gainer across the NSE. So that should tell you something. Yesterday, it started flat, and you had that TBO Tech, which started with a 50% pop. But Aadhar Housing, 20% CAGR in AUM is what they are kind of expecting. They're one of the largest actually in the space. AUM size is about nearly 20,000 crores, and largely lends to the salaried segment. What else? I think we mentioned Apollo Tyres, Titagarh, I think we did mention. IEX is up about 2.5% or so, 150 nearly, and it's got very large volumes coming up now. Nagarjuna Construction is up about 5%, it's got large volumes. Oberoi Realty, look at Sterling Wilson Solar, 3.5% higher on that one. Yesterday, of course, was, I think it's a new high, a new all-time high. So 786 now on this one, after yesterday's 5% gain. There is Kirloskar Brothers, which is up 3%, again strong gains. IIFL Securities had a strong day yesterday. That is up about 4% or so. And there is, I think, Jyoti Laboratories, which is up about 1.6 odd percent as well. So it's overwhelmingly up. 1650 stocks are higher, and you've got some under 400 stocks which are lower at this point in time. On the way down, there is only NLC India with a 4% cut. With any volumes, Bandhan Bank maybe is another one which has got volumes. That is down about 2.5 odd percent as well. Sonia?
Just that rural theme we were talking about, right?
Yeah.
How rural is coming back. In the auto space, it's very apparent because all these stocks, whether it's M&M, Hero MotoCorp, Escorts, all at fresh 52-week highs this morning. Ashok Leyland is also rising quite a bit. So that is one theme that's playing out in its entirety now.
Absolutely. And, that's absolutely true. Autos, of course, have done extremely well. It's been perhaps a sector of the last year or so. Well, let's welcome in our market master of the day. We have Nimesh Chandan, who is joining us. He's here in our studios. Nimesh, good morning. Great to have you with us here. Thanks,
good morning.
For coming in. Now, we'll talk about markets broadly and what your view is, but I want to start with the entire industrials segment, capital goods, equipment makers. Yesterday, we saw this big move in names like Thermax and CG Power and what you have. Everything went up, right? Siemens and ABB are up 70%
Absolutely.
this year. As a fund manager, I mean, when you're sort of starting to put fresh money at work, how do you do it? The only thing, as someone was joking yesterday, is they've got to find a stock in that space under 100 PE and, then go with it. Your thoughts, Nimesh?
So as a fund house at Bajaj Finserv AMC, how we look at it is we identify mega trends which can impact economies and businesses over many years. So maybe as a mutual fund, we take the luxury of looking at about 3 to 5 years at least when we are identifying these large trends. Typically what happens in that wave, say for example currently power sector, you see all the components or all the beneficiaries of this trend start doing well. Suddenly there is a good tailwind for them to show better earnings, and for many of these companies, because of operating and financial leverage, if the top line starts jumping up, you see a huge delta on the bottom line. And once the trend catches attention and the idea spreads, you see valuations also moving up. During these phases, it is better not to try to trade in and out in these trending companies. If you find a good replacement which is at a better valuation, you switch. Otherwise, you stick with them. The one thing to watch is whether these companies are beating estimates or they are underperforming there. Typically, a trend matures when you see more and more companies underperforming what the analysts or the investors are estimating from them. So high valuations may not be a reason to just trade out of these companies. Possibly they go through some time correction.
But if you already own it, stay. There's no problem. I mean, great, enjoy. I'm saying as somebody looking to buy, how do you do that? That's the the dilemma.
So hunting in these markets for a newer investment, I think a contrarian view is essential. You have to take advantage of this impatience that market is into, right? Any company that is going through a downturn for the last 2-3 years, the market is typically ignoring them. They may be in either the banking sector or say the consumer sector. I think those are the areas to now fish. Within say a longer term theme that we see which is going through a temporary slowdown is chemicals. This is an area where you can actually find good companies at good valuation with a good structural mega trend in place. So hunting in contrarian areas, if you already invested, don't try to trade out or move out just because of valuations in the trending areas.
Okay. Nimesh, hi. Thank you first of all for coming here to the studio and speaking to us. I was going through some of your notes, and a space or a segment that you like is rural consumption, right? You speak about how it seems to have bottomed out and the fact that we're expecting good monsoons could make for potential incremental recovery. But which are the pockets there that I can look at? Because there's so much. There are the HUL Daburs of the world, there are tractor makers, there are SUV makers. Where does your preference lie?
Many of these sectors will benefit, but let's say two-wheelers have discounted some part of that recovery already. They've actually performed very well, and even today in the auto sector in our pecking order, we see two-wheelers having a higher single-digit or lower double-digit kind of growth rates, followed by PVs and followed by CVs and tractors. But FMCG as a basket has underperformed for quite some time. Yes. Valuations have come down, they've taken a time correction. Many of these companies are now seeing margin expansion also because of commodity prices being a little more benign. So if you want to bet on a good recovery with good quality companies with cash flows and good dividends, then FMCG would be the next big thing to look at.
So just a follow up there. So within FMCG, I mean, there are different pockets as well, right? There are the HUL Daburs of the world. There are a couple of the other smaller guys as well. So do you just look for an overarching recovery and then valuation headroom and then pick stocks, or how do you do it?
I think the whole sector is at a lower end of its valuation band, and the premium that they used to enjoy compared to the Nifty or the sensex has come down substantially. Companies with at least having 25-30% of their business coming from the rural side, I think that's where you start scanning businesses. So you would find certain MNCs which are more urban oriented have already seen good numbers. The rural part will start kicking in from here on.
Okay. So you started off the conversation by saying that you look to identify some mega trends from a 3 to 5 year time horizon. Chemicals is one. The second one appears to be consumer staples. What else have you identified?
We look at mega trends originating from the technology changes, regulatory changes, economic
tell us the
changes,
themes that you like. Where
so
there is a
within, say, the pharma sector, we like a sub-segment called contract research and manufacturing, both in terms of cost and economics, as well as the regulatory changes going on globally in terms of China Plus One. This is one sector which is underappreciated and benefits a lot. Overall, we like lifestyle consumption, so consumer discretionary. This is again an area which we like for the next 3 to 5 years. Real estate is a very positive trend we are seeing. Typically, it's a 6 to 8 year cycle. We are probably 2-3 years into it, so we still have a long runway to go there. And real estate, as you know, affects a lot of other ancillary industries also in building materials and so on.
So what about defense, right? That's a big mega trend that's been playing out for the last 2 years.
True. We like defense as a mega trend, but now the valuations of many of these companies have reached a level where either the upside is a little lesser than what we are looking for, or we'll have to see some of these companies show execution and then go to the next leg of re-rating for them. Just the order books, I think, have already been priced in.
Nimish, on chemicals, is this extreme performance, this up and up market, forcing us to look for opportunities? Is it turned? I mean, my question is for chemicals, can you size up and buy and wait for the turn? Or is it iffy? I mean, it may happen, it may not happen. Or is valuation comfort so good that you're okay waiting? I mean, if it doesn't happen next quarter, 2 quarters, I mean, it'll happen. What's your sense?
So we look for two important, say, data points before we take a contrarian call. One, we need to be sure that the intrinsic value lies much higher than what the prices are. Second, there should be a trigger in sight. Say within a year, to see the re-rating happen. Why should a cheap stock become expensive? There has to be a trigger. So in chemicals, we find both of these. And so the intrinsic value is much higher, longer term trends are much higher. If you see globally, for the last 2 quarters, most of the large chemical companies, whether you take FMC, DuPont, any of them, they've been talking about that destocking is at a fag end. We'll probably see sequential improvement in volumes and prices from here on. So that gives us comfort, the commentary, and the value that lies there.
And what kind of names are we talking about? I mean, I don't know if you can name names, but if you can, just for educational purpose, it'll be helpful.
So I'll split between, because chemicals is a wide space. Sure. There are many companies that are into specialty chemicals. There are certain discretionary chemicals like dyes and pigments. So First, we are seeing some recovery there in the dyes and pigment segment, and there are a few companies which are beneficiaries.
So Sudarshan Chemicals and things like that. I mean, not maybe others as well.
So you saw globally one of the large majors in dyes and pigments actually declared bankruptcy, and that has led to some of the Indian companies, like you mentioned, see a benefit of both in price and becoming a larger market share. And there are other companies which you see have done capex in the last 2 years. So they have increased their asset size by double, but are yet to see that trigger come in. So some of those can be areas to look at. Agrochemicals may be an area where there could be some more slowdown before they start recovering.
Okay, one space or one theme that you talk about is the K-shaped recovery that India is going through, right? It may not necessarily be a great thing because it also talks about that huge income divide. But from a stock market angle, how do you play it? Because a lot of these premium products or premium segments, whether it's real estate, whether it's aviation, whether it is SUV, large cars, right? We've seen a lot of it play out in stocks already. So where do you see incremental gains to maximize on this K-shaped recovery theme?
We are probably still at the beginning of this upgrades in consumption. So while we saw K-shape, which means the premium consumption did very well and the bottom of the pyramid did not do well. I think from here on, if rural also recovers, we even see bottom of the pyramid starting to do well. But these bigger trends, which like, SUVs becoming a large part of auto sales or large ticket real estate being part of the total real estate sales, these trends are likely to continue.
Okay.
And picking up companies that give room for their for their customers to upgrade, I think those would be the key beneficiaries. So here, brands, quality, all these things would play a big role. And we are very conscious of some of these companies where they give a line of products where their customers can keep upgrading and spending more with them.
So there are two things working out here, right? One is, of course, India is moving from a low income to a middle income society. And the second is this demographic dividend play that I think is going to mature in about 2040. So to play these two themes, which are the spaces you think where there's maximum potential?
It would be consumer discretionary, and as confidence in income grows, there will be even confidence in leveraging. So finance and consumer. If you see historically, large economies, when they have moved from the stage that we are into a more developed economy or Viksit Bharat, you will see these are the two spaces where good brands and companies with good moats or competitive advantage in their business will start doing better.
Okay, we'll let you go on that one. It was really a pleasure speaking to you, and you should come to the studio more often to chat with us. Thank you. Okay, well, on the market, it's not bad. After the kind of run-up that we've seen in the last couple of days, we are facing a bit of resistance around the 22,300 mark, to be honest. But for now, it's steady state. So not looking too bad. In terms of individual stocks, just a quick mention. Titagarh Rail is really a big mover, 8% higher. And Apollo Tyres, after those upgrades that have come in post the numbers, Apollo Tyres is one stock which is looking pretty good. But let's talk about Berger Paints. For Q4, their EBITDA was impacted. Margins have contracted, while the value sales are impacted by about 5%. Their Q4 volume growth came in at nearly 14%. Let's connect with Abhijit Roy, the MD and CEO of Berger Paints, to discuss their Q4 performance. Abhijit, hi, good morning, and always good speaking to you. This discussion we were having about the recovery in rural consumption, right? Or tier 2 and tier 3 consumption. How much merit is there in that argument? Are you also seeing green shoots? If yes, can you quantify it for us? And this 14% volume growth that you saw for the quarter, is this something that is sustainable in the first half of FY25?
Yeah, so morning, Sonia, and there has been an improvement in the demand in the rural areas, in entire 3, 4 and upcountry towns. As we see it today, this demand is likely to continue. So in the first half, I think we should see sustainable volume growth happening. As we have seen in the fourth quarter and even for the whole year, we are a double-digit volume growth. And that is likely to continue, going forward as well.
So when you say double-digit volume growth, right, is it fair to assume that you'll hold on to this 12-13%, or do you think, given the kind of competition that this space is also seeing, by the end of FY25, is 10-11% something that is a more reasonable ask from your end?
So difficult to say at this stage, Sonia, because as of now, the competition hasn't been, biting us so far, but obviously it will have some impact. Our estimate is that we will still be reasonably sure that, we will still have a double-digit volume growth at the end of the year as well. We have been gaining market share even under, this last year as well, we gained market share overall. And our objective is for the last 2 years, we have gained about 0.7, 0.8%. And that's something which we will continue to do, hopefully, next year, this year as well.
Sir, while your volume growth may be double digit, the value growth has been a lot less. One, because of the price cuts that you took, but also the mix is changing. There was destocking seen in the luxury segment. There is higher growth seen in the low valued, paint segment. So what's happening on that front? And what's the outlook?
You are right, so mix is changing slightly. Of course, the destocking which happened in the luxury products is going to stop because there was an anticipation in the market, and dealers typically, when there is a anticipation for a price increase, they tend to stock up. When they feel that there might be a decrease, they tend to stock down. So that destocking happened in the Q4 for luxury products because that's the only category where prices hadn't dropped. All other categories prices had dropped. So the dealers expected the prices to drop in luxury as well, and they were holding on to their purchases to some extent. That's going to come back in Q1 and Q2. So you will not see that destocking happening this quarter. The second part is the low value and high volume products like admixture, tile adhesives, putty to some extent maybe. Those are growing at a faster pace. That will continue to happen because it's coming on a lower base, so the growth rates are much higher. But that is not a worry because those are also reasonably profitable, so it doesn't matter so much. The volume growth therefore will be on the higher side. This price decrease impact will continue for some more time. So therefore, the volume value gap will be there to some extent.
Mr. Roy, hi, good morning. Good to have you with us here, sir. Prashant this side. Could you tell us for FY25 then? I mean, sort of putting all of this together, what is revenue growth going to look like?
So it will be marginally below the double digit, possibly very close to the double digit volume growth number, but below that slightly because of the price deflation which has happened, and right up to December we will have that impact unless there is a price increase happening in between. Logically speaking, there will be a 2 to 3% differential between the volume and the value growth at the end of the year. That's where it will be. And profit growth will still be reasonably good. As we have seen, this year, of course, was very strong at about 24% plus growth. But here it will be similar to the volume growth, possibly. That picture will be more clearer once we move forward a little bit.
So, 9% kind of top line growth is what you're kind of guiding for?
Sort of 8 to 9%, you can say, for the year.
8 to 9% revenue growth. What about margins, Mr. Roy? Let me just sort of tie that in as well. Will that be around FY24 levels, 15.5%, or will it be
similar
slightly
levels? We have always said that it will hover between the 15 to the 17% range, and that's where we will remain for sure.
So around, but it should be at the lower end, right? I mean, around 15%.
No, not necessarily. It can be, more towards, the middle of the, equation, 15 to 17. So 16% is more or less, where we will be possibly.
Okay, I want to talk a little more about any changes on the ground yet with Birla Opus coming on board. I know you said that competition has not, affected you yet. But do you fear that there may be price cuts across the system just to stay in the game a little more? Or do you think that the pie will grow enough for everyone to have, a fairly decent organic growth? Just trying to understand the dynamics now.
So as of now, it doesn't look like that, there will be intensification of price cuts happening, to sustain volumes. That's unlikely given the current situation, what we have seen so far. It seems that the market has taken this in its stride, and our sales have been relatively unaffected, I would say, even in the locations where they have launched already in a decent way. So therefore, I don't see this impacting us in a significant way at all.
Okay, you were telling my colleague that you saw about a 0.8, 0.9% gain in market share, right? So fair to assume that market share is somewhere around the 20-21% level right now for you?
So in over the 2 years, we gained last year about 0.4%, this year again about 0.4%. So we are around the 19.7, 19.8% level. And hopefully we will cross the 20%, mark, this year.
So anything else that you're doing in order to stay in the game, to combat competition, to make sure your market shares at these levels? Any strategy that you have for the next couple of years?
Yeah, so three things are there. One, we are relatively have a weaker presence in certain markets, especially in the urban centers, in the west and the south. So we are, putting up a separate effort on that direction. Growing our market share, our distribution reach first, and then trying to develop our sales in those locations. So that's the first thing which is going to happen, and where we have some interesting strategies around that, which will help us. The second is, of course, spending on branding and, strengthening our brands further. We increased our brand spends last year substantially. This year, too, we are going to increase further on that. Last year, the increase was to the tune of almost 40% in terms of spend increase, both digital and television. And this year also, there will be a growth on that. And we expect that, that will strengthen our brands. It's very important in the time of competition also to do that, and that should help us, going forward.
So, what was your overall branding and marketing spend as a percentage of sales in FY24, and how much will it go up in FY25?
So that, as I said, it increased by about 40% from last year in terms of growth. I can't exactly remember what the percentage to sales was. And I expect that this growth will not be at that level. It will probably be more around 15% odd level this year as well.
Okay, and in terms of retail distribution touch points, do you have a number in mind?
Yes, we are going to add about 8,000 color bank tinting machines. Last year we added about 7,100. This year we are going to add another 8,000. That's a substantial number, to be added, to our current numbers, which is about 40-odd thousand.
Okay, I want to understand also from the waterproofing and tile adhesives segment, what kind of opportunity do you see? I mean, how much do you think your business can grow in this space? What could the percentage contribution be, and what's the overall opportunity?
Massive opportunity there, Sonia. In fact, this is the fastest growing segment in our portfolio as well. It's growing well. It's in double digit of contribution almost, today. And we see this, segment growing at a very, very rapid pace going forward.
Okay, so what is your aim? I mean, how much would it, I'm sure it's very, very small right now, but how much do you think it can contribute to your overall business, say, over the next 3 to 5 years?
No, it isn't small. It's already crossed 1,000 crores, so it's not small at all. And I see this growing at quite a rapid pace, so this will be one of the big growth drivers for us going forward.
Thank you, Mr. Roy, for joining in, and wish you all the very best. Need to get into a very short break. On the other side, we'll invite Saurabh Gupta of Dixon Technologies to talk about the Q4 earnings and the way forward. We'll also invite Umesh Chaudhary of Titagarh Rail Systems.
Welcome back. You basically have a situation where the market has given up gains. About 50% of the gains, morning opening gains, have been given back, and we're up about 45 points. So, the template from the last couple of days continues into today's session as well, although handover from overnight markets was much stronger than we've had lately. But we're, of course, on the earnings track, and the next company we are speaking with is Dixon Technologies. It's been a market darling, stocks at a new all-time high. Fourth quarter earnings missed expectations. Maybe expectations were perhaps a little too high, although outlook, of course, remains pretty upbeat. And there is a lot of interest. And there are so many tie-ups and so many reports of acquisitions, etc., which Dixon is going to undertake this conversation should be interesting. We have Saurabh Gupta, CFO at Dixon, now joining in to take some questions. Saurabh, good morning. Good to have you with us here as always. Thanks for your time. Prashant this side. First, let's just get the headline kind of numbers out of the way. Saurabh, so in FY24, you did just under 18,000 crores in top line. With all the tie-ups and acquisitions, etc., that you have done, could you guide us to what revenues in FY25 may look like?
So Prashant, I will not give any specific guidance, but I can give you some levers for that. So clearly, if you look at mobile is the largest opportunity for us and is the largest trigger for our growth. The financial year 23-24, we did a volumes of somewhere closer to 7 million smartphones and almost 38 million feature phones. Now, the 7 million smartphones has the potential to almost go to almost 28 to 30 million this financial year. And so we have added a lot of customers. We're looking to add some more brands in this category. And so that will be the largest trigger for our growth in this financial year. So please be rest assured the growth overall will be quite strong in this financial year.
The number that I have, and this, of course, the street is where it is at, the revenues could be about between 30 and 32,000 crores. Does that seem plausible?
Yeah, that seems possible, Prashant. And a large part of that 32,000 that you mentioned will come from mobiles as a category. Yeah.
And just to tie in the numbers before we dive into specifics, margins were about just under 4% in 24. Could you sort of tell us, will you be in the ballpark there? Is there room to improve this?
Yeah, so the positive drivers for us, Prashant, on the margin side would be, of course, the operating leverage kicking in. So in some of the verticals, it has kicked in. In some of the verticals, it will kick in, especially in the mobiles vertical, where we have made the investment. Secondly, I see that more backward integration we plan to do across verticals, and especially on the mobile side. We are looking into getting into the display for mobile smartphones, which will be really margin accretive and ROC accretive for us. And also, we are looking in some categories to get into designing as well. So those will be the positive drivers of margin. But however, mobile, which is slightly a lower margin business for us as compared to other businesses. So my sense is the margin profile would hover between sub 4%, 4.1, 4.2%, so somewhere between 3.9 to 4.2% kind of a range.
3.9 to 4.2%, right?
Yeah.
Okay, so 30 to 32,000 crores in revenues and margins between 3.9 to 4.2% for FY25. Got it.
Okay. Saurabh, hi, good morning. So you've helped us with a lot of numbers. You're saying 7 million smartphones currently. It could rise to about 28 to 30 million in FY25. You also earlier had an aspiration to scale up these volumes to about 40 to 45 million by FY26-27. Are you on track with that guidance as well?
Yeah, Sonia, we feel confident that next financial year we can take those volumes to around 40 odd million. So if you look at the total opportunity capacities for us, we've already created capacities of 45 million for smartphones and almost 40 million for feature phones, which is almost 50% of the opportunity pool which is available on the outsourcing market in India on mobile phones. So it is definitely we have created the largest capacities in India, and now we're looking to get into more backward integration in this category.
Okay, got it. And, you started off with just Motorola as one of your key clients. Then you got into many other into tie-ups with many other players. But I understand there's one more large client that you're looking to close over the next 3 to 4 months. In terms of a timeline, are we on track? And what kind of value add do you think that client could bring on board?
Yeah, so we are absolutely in very deep discussions and active discussions, and we are very confident that we should be able to get them on board and start manufacturing for them in the next 4 to 5 months. So the numbers which I've given to you for this financial year on smartphone side factors into account that new customer acquisition as well.
Okay. What about the lighting and the consumer business, Saurabh? That's been weak. I think lighting was down nearly 25% in FY24. Even the growth has been restricted for the TV business. Are you expecting growth in FY25 for these two segments? And if yes, how much?
See, lighting has gone through a difficult times. There has been a big pricing erosion which has happened, pricing erosion to the extent of 30-35%. But now what we are doing is basically we're getting into some other categories apart from the indoor lighting category. We're getting into professional lights, which is street light solutions. We are also investing more into the ceiling lights. We're getting into the backward integration of for mechanicals as also for extrusion for battens. And we are also working on some export orders to US US, and some of the exports to Middle East and Europe have already started. So my sense is it will take a couple of quarters for us, but I think so we should bounce back in the lighting business, and we should have a decent growth in this financial year. So I think so the worst is behind us as far as lighting is concerned. On the consumer electronics side, I would say it's a tough industry because we already have a 60-65% market share in this category, and the opportunity pool is not growing. So what we are doing as a company is that we are getting into more backward integration for mechanicals, getting into LED bars, getting into more and more of own design solutions, which is basically Google design solutions and also Tizen-based solution under the partnership with Samsung. So more backward integration and designing will lead to more margin expansion. And so yeah, maybe another couple of quarters we should see better numbers in this category as well.
Okay, just one more question on margins. You've guided for margins of 3.9 to 4.2% for this year. And you are also planning a lot of margin accretive steps, whether it's display for mobile phones, design categories, backward integration. So this margin guidance is including all the steps that you're taking, or the benefit of backward integration and the margin accretive steps shows up only in FY26?
Yeah, so display for mobile phones is that we have just in the final stages of closing with a technology partner. We'll be creating a capacity of 25 million display modules. My sense it will take 5 to 6 months, so the results will only start reflecting in next financial year. So there can be a significant margin expansion, which can be possible on account of this in next financial year. But as of now, for this financial year, I'm not building too much of this backward integration of mobiles that we're planning.
Okay, so FY26 margins, sir, Saurabh, what would it look like?
There can be another 10 to 20 bits kind of an expansion, mainly on account of the backward integration and more operating leverage playing in.
Okay. And Saurabh, in smartphones, just wanted to confirm, you said FY25 smartphone units for you should be between 28 and 30 million units as compared to 7 in 24, right?
That's right.
Yeah, okay, got it. Now, just wanted to there are so many companies that you're working with, looking to work with, the new tie-ups, etc. So there was a report which, early April, which said that you're in discussions to buy a majority stake in the local manufacturing unit of China's Transsion Holdings. I know they make phones for brands like Techno, Infinix, etc. Could you confirm that?
Yeah. So we have done that acquisition. We are waiting the approval of Competition Commission of India, and hopefully we feel confident that we should get those approvals by next month or so, and we hope to consolidate and consummate the transaction starting July onwards.
Okay, so this is one of the three kind of acquisitions, tie-ups that you've done, right? Transsion. And this is all baked into the numbers that you gave for FY25.
Yeah. So that 28-30 million, I've already taken into account the 9 months impact of this acquisition as well. Yeah.
Okay. Could you give us a sense on IT hardware as well, Saurabh? What is the revenue potential here for Dixon over the next 1 or 2 years?
See, IT hardware is a large opportunity, Prashant. There's a $10 billion opportunity worth of IT hardware products which are imported into India. So there's a big import substitution opportunity, and government is very much committed to it. So they have brought about a PLI whereby and they've increased the budgetary outlay in that scheme, and also they put some kind of a restriction to encourage domestic manufacturing. So my sense is we've already signed contracts with Lenovo and Acer. Acer we are already manufacturing. For Lenovo we start manufacturing by Q2 of this current fiscal, and we're also in discussion with more brands. But I think so those numbers are getting worked out. This year, it may not be a large number for us, but in coming years, it has the potential of becoming a decent revenue stream for us after mobiles. Yeah.
What is that decent number? Could it be just some sense? Say in FY26, for example.
It can be anywhere between 4,000 to 6,000 crores, Prashant, for us.
Okay, between 4,000 and 6,000 crores in FY26. This is IT hardware right now. And in terms of any other allied areas, not allied actually, new areas like semiconductors, etc. Any plans for tie-ups? Are you thinking on those lines at all?
So one thing which we are looking at very seriously and we'll pursue it very aggressively is the PCB opportunity. for industrials, electronics, or automotive space. We are working on some large RFQs. We are setting up a campus in Chennai. We're putting up a team. So clearly, we see a lot of opportunity in that category. As far as semiconductors is concerned, we are not looking into it right now.
Okay. All right, fair enough. So PCB is for industrials is a large opportunity which you will pursue aggressively. Saurabh, we'll leave it there. Thank you very much for your time. Great speaking with you and good chat as always. So that's Dixon Tech with some perspective. The market had sold off, but is I think trying to make a comeback. We're up about 60 odd points, 22,258. Rima.
All right, let's move on and invite the next management on the show. That's Titagarh Rail Systems. Significant gains coming in on the stock. Strong Q4 margins for the company have expanded. Profit has seen a very strong growth. And it's the freight segment which has seen strong execution. Umesh Chaudhary, Vice Chairman MD of Titagarh Rail Systems, is with us now to talk about the way forward. Umesh, morning, and thank you for joining in. First, if you could just give us some numbers. What's the order book and the split between passenger and freight segment? And when does passenger freight, passenger execution pick up?
The total order book we have as a company is about 28,000 crores, which includes our share of our joint ventures or consortium bids where we have won tenders, out of which it is approximately half and half, which is in the consortium stroke joint venture. Of course, when I'm talking about that, half is our share of the consortium, not the complete order in the consortium. And further drilling down the passenger and the freight in the 14,000 crore of direct orders that we have is again split half and half. So that's the overall order book. And as far as the execution is concerned, we completed Pune Metro. Almost all the trains are now supplied, and they are running well on the Pune tracks. And we are starting the Bangalore Metro execution from Q1 end or Q2 beginning of this financial year. So, this is the intervening period because, we had the first contract of Pune and then we were setting up the stainless steel line where there were some delays on account of the visa issues for the Chinese engineers. A lot of equipments actually came in from China, and that kind of delayed the project by a couple of months. But now we are on track and we'll be starting production in the matter of next few days itself.
So what are the targeted revenue bookings at the end of this year?
So this year is going to be, of course, much better than the previous year, but not going to be the optimum because, as I've always said, that the passenger business is a kind of a nascent stage, is at a nascent stage. We will have the Surat and Ahmedabad kick in this year. Vande Bharat will start from the next financial year. So the real potential of the passenger coach will be seen in FY 26-27. So in both FY 26, we will have a substantial jump, and FY 27, there will be a further substantial jump of order execution that we have on hand.
Okay, 26 onwards, basically. Mr. Chaudhary, what is your ideal PV versus freight business mix?
The passenger business actually has a greater potential. So, if I really look at it, maybe 5 years down the line, I would say that passenger business should be probably 60-65% of our revenue.
Do you have any fresh orders in the passenger segment?
There are a number of tenders that are in the pipeline. There are several metro tenders, and then there will be additional Vande Bharat tenders. We've heard the Honorable Railway Minister speak about waiting list free railway system and 3,500 new Vande Bharats being added over the next 5-7 years. So there is a huge, I would say, traction in this segment. So many metros, there is the Mumbai Metro, the 3 lines which are getting ready. Then there is Chennai, there are 2 lines. There is additional Delhi. So there will be a number of metro tenders that will be coming up that are already in public domain and that will come up in the coming months and years. So we don't see that order booking will be a challenge. The way we are structuring ourselves is we are creating a capacity to produce approximately 400 cars of metro per year and 400 cars of Vande Bharat per year. And we believe in the first phase. So we believe that there should be enough business in the market to be able to take up this capacity.
What's the target on monthly production in the freight segment?
So we, on an average, we did 900 wagons in the last quarter. We did 2,700 wagons. Of course, in March, we did more than 1,000 wagons. This year, our target is to get to about 1,000 wagons on an average. So let's say between 950 to 1,000 wagons on an average. And we believe that that is, considering the overall market demand, that is the right sizing for us for the wagon. And then we will see the new freight corridors that have been announced by the government. As in, when they come up, the demand goes up. Currently, we believe that the demand is about 30,000, 35,000 wagons a year. For that to produce about 10.5, 12,000 wagons by us is a fair market kind of share. And if we see on an overall basis, what we did last year was approximately 8,400 wagons, which is an average of 700 wagons. So from there, we would like to get to 950 to 1,000 wagons on an average this year.
Got that. Mr. Chaudhary, could you tell us what margins are you aiming for in both segments?
So I've always maintained that as far as the freight is concerned, the fair margin, I used to earlier guide at about 10%, but because of the operating leverage, I would say 11.5, 12% is a fair margin for the freight business. They can vary from quarter to quarter based on how much private wagons we execute, how much railway wagon we execute, which type of wagon we execute. But on a blended basis over a few quarters, I would say 12% is 11.5 to 12% is a fair number to estimate for the EBITDA margins for the freight business. As far as passenger business is concerned, this is very important to understand, because the margin improvement in this will happen on stages, in phases. So right now, of course, we don't have in fact, we have a disadvantage of operating leverage because we have created a large fixed cost. We just opened an engineering center in Bangalore this month itself. We have a joint venture engineering center in Hyderabad. We have a large engineering center in Calcutta. And all of this is going into the cost. We have very large setups that we have created, which is primarily going to get the benefit of that is going to come in quarters to come, wherein we are able to scale up our operations. So we believe that when we are doing the passenger rolling stock, when we get to a base level of at least 15 to 20 coaches, which should be achievable by Q3 of this year or Q4 of this year, we should be able to do 10% EBITDA margins approximately. And when we are integrated with propulsion, which should happen in FY 26, then our EBITDA margin should see an improvement, and we should be targeting between 13 to 15% EBITDA margins.
So with all that you're aware of, revenue and margins, what could they be in terms of, FY 25, FY 26? What are we looking at in terms of annual growth?
So we don't give any kind of guidances. We don't give any forward-looking numbers. But, we have a large order book. We have a healthy order book, which we have to execute. We are ramping up on capacity. We have delivered, if you see, from 2,800 crore in FY23, we have done 3,850 crore in FY24. Our EBITDA is almost 450 crores in FY24, which is quite substantially higher from FY23. And that trend continues over the last 5-6 years. So if you look at the company in FY18, 19, around 18 or 19, we were at a top line of 300 crore. Now we are at a PAT of 300 crore.
Thank you, Mr. Chaudhary, for joining in. So that's Titagarh Rail. For the market, after opening with a gain of close to about 100 points, the gains have whittled down to 25 points. So there has been some profit booking set in the first 1 hour of trade. But Bharti Airtel continues to see buying, and that's moved up to the day's high, 2.5% up on Bharti Airtel. JP Morgan has upgraded the stock and put a target price of 1,500. So that's been the big winner. Mitesh is now back with us for some 10 a.m. calls. Mitesh, the profit booking which is set in the first hour, your thoughts on that, and what would your stock calls be?
So we've kind of come back from higher levels after a gap up opening. But as I said, I think till we actually start trading below 22, 200, 180 zone, I think I'll maintain a positive stance. So hold on to your long positions or even buy with this 50, 60 point kind of a stop. On the stock side, overall reality is having some kind of a breakout. So 1650 is the recommended stop. I would look at targets of 1765 here. And Nestle, I think, is one stock which is tapering on the negative side. So sell here with a stop at about 2470 for targets of 2400.
Okay, we'll do one thing. We'll take a quick break on that note. When we come back, we'll put focus on the commodity space. We'll also talk about some of the big stocks in focus this morning. Stay tuned. Well, there's also lots happening in the commodity market. So Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm tracking monsoon this time because we have been hearing for the last couple of days updates coming in from IMD, so I'm going to analyze that. Well, in the latest information that IMD came out with in the previous evening, they said that the southwest monsoon onset over Kerala is likely on 31st of May. This is one day earlier than usually what we see as a date of 1st of June, but there's an error of plus minus 4 days that IMD has put out with this day as well. Monsoon onset in parts of Bay of Bengal, Andaman and Nicobar is expected on 19th of May, and this is 2 days prior to what we usually see happen here as well. I want to take you through on what really have been the forecast from IMD and the actual monsoon that we've seen in last many years there. And when you look at the table that would come in, it only has been a couple of times that IMD has said that you could be looking at monsoon on 31st of May. One is this year and the last time was in 2021. But when you look at the actual onset of monsoon, it only has been once, and in the month of May that you have seen the monsoon come in. Apart from that, it always has been a month of June that the monsoon has come. And this time around, of course, with an error of minus plus 4 days, the expectation is that it could perhaps be June before you see those monsoon showers here. Also, when you look at the prediction for this year in sense of monsoon, IMD has talked about above normal monsoon at 106%, while SkyMet talks about normal monsoon at 102%. I also want to take you through last few years on the kind of monsoon that we have seen in sense of final numbers there. So we're looking at 106% of a forecast. The last time you saw that kind of a monsoon was in 2022. Last year, remember, was an uneven, jittery and least monsoon that we've seen in the last 4 or 5 years at 94%. But the last couple, 2020 and 21 was great years, by the way, 109, 99 to 106%. So 20, 21, 22 were good years, 23 not so much, but 24 is going to be very important, because we did see previous monsoon not so great, and that did lead to commodity prices, agriculture production and prices both going on the higher side, and did lead to curbs coming from the government as well in sense of exports of various commodities like rice, wheat, onion and sugar in that sense also. India does receive 70% of its annual rainfall in the month of June and September. Remember, even as irrigation as a concept has been spreading in India, but the latest numbers from Ministry of Agriculture do show that it still is 51% of India that still depends, is a rain-fed really. Monsoon also is important this time because we are looking at very low reservoirs. The groundwater reservoir also has been declining, and there are important kharif crops that the government would be keeping an eye on in sense of production there. So you have rice, corn, cotton, sugarcane and soybean that you are looking at in sense of important kharif crops in the season that is going to start very soon there. The uneven 2023 monsoon did lead to various curbs there, and that is something that the street will look out for in sense of crops and ensuring that you don't see that kind of concerns. IMD also has come out with a couple of very important statements. One, that El Nino is weakening and La Nina will set in by August. So you would be looking at a stronger second half in sense of monsoon there. IMD also has said that it would be in the last week of May that they would come out with a geographical forecast as well on north, east, south and west on what kind of monsoon would these various reasons, would these areas see. So that is something that the street will keep an eye on.
Okay, thanks a lot for that. Well, plenty of stocks buzzing around right now. So let's take stock of some of them. Apollo Tyres is what I'm looking at this morning. There are a couple of upgrades that have come in post the numbers. So Nomura has upgraded Apollo Tyres to a neutral. They have a target price of 512 rupees on the stock. You have JP Morgan that has upgraded to an overweight. They've raised their target price to 555. Morgan Stanley has an equal weight with a target price of 472. Now, brokerages say that the company continues to demonstrate its commitment towards balance sheet deleveraging. The biggest focus area for them is a reduction of their debt. And even the current valuations, if you look at the way the stock is trading, it's trading at 6.5 times FY26 EV to EBITDA. And it does not look expensive compared to some of its peers. There is limited capex intensity now, and that will free up their cash flow. So that will continue to drive free cash flow positive, and hence multiple reasons why brokerages have upgraded Apollo Tyres, and the stock is in the green this morning. But Mangalam is joining in to tell us about Somani Ceramics and why he's watching that one. Mangalam.
Well, for Somani Ceramics, it's a good performance that has come in more so on the operational side. We've been speaking about how gas prices increasing have impacted the margins of all these tile makers, but now that is coming undone, just the way we are seeing decline in all the other raw material prices as well. So for them, an 8.5% jump in the company's overall revenue in the fourth quarter has led to a 30% jump in the EBITDA, margins improving from 9% all the way up to closer to 11%. And the reason for that is because power and fuel as a percentage of sales have come down from nearly 23% to about 19%. So that's a big decline that we've seen, and that's aided their margins going forward. And the other internals are also pretty strong. The fourth quarter volumes have picked up. It's about 7%, which is much higher than the previous 9 months that we've seen, because the entire full year volumes are close to around 5%. The company has alluded the margin improvement to stable input costs coupled with some of their efforts on cost optimization, and some of their joint ventures operating performance has also improved. So they believe that going forward, their margins will get only better. So they've guided for better results going forward, not only on the operational front, but post-monsoons pickup coming in from the demand standpoint as well. And the street likes that. The stock up nearly 15-16%.
Okay, thank you very much for that. Redington is another stock that we're looking at. It's down close to about 4% on the back of its numbers, disappointing numbers. Revenues are down 4.5% quarter on quarter, and on a year-on-year basis, revenue growth is just 2.7%. In fact, the revenue growth of the company has been coming down. About 4 quarters back, the revenue growth was over 20%, and this quarter, as you can see, it's steadily come down to 2.7%. Margins too have been under pressure. So quarter on quarter, margins are down from 2.2 to 2%, and significant fall on a year-on-year basis. For the full year, FY24, the company's ended with margins of close to about 2.1%, the lowest that we've seen in the last 3 years. Profits too have come under pressure. Now, this is a distributor for hardware and now even software. So they have a few cloud projects as well. But the company has been taking a cautious approach towards growth, and they're looking at balancing growth and profitability. So, last quarter they told us that, towards Africa, they're taking a cautious approach. They're reducing the solar business in Turkey due to the risk price volatility. So I think the company is now focused on balancing growth and profitability, and growth for the company has slowed down. That's Redington for you. We'll get into a break. On the other side, we'll get you some key takeaways from our exclusive conversation with Avenue Supermart CEO Neville Noronha. Post that, Abneesh Roy of Nuvama Institutional Equities will join in to discuss those key takeaways and the outlook for the retail sector.
Welcome back to Bazaar Corporate Radar. It's still holding with gains, minor gains in the market, but very interesting conversation coming up. My colleague Mangalam had an exclusive chat with the Avenue Supermart CEO Neville Noronha, someone who rarely speaks and someone whose voice needs to be heard more often. But now we have Mangalam standing by the wall with a few big takeaways from that conversation. Over to you, Mangalam.
Well, how I wish this was a video interview that we had, but you take what you get with the likes of Neville Noronha, rare voice, but extremely important as well, especially with the kind of success that DMart has seen in the retail space itself. The last conversation that we had was about 6 years ago. In the middle of that, there was a pandemic, a big surge that we saw in digital as well. So with all these things, the big obvious question was, what are the structural changes that have taken place in the modern retail world in the last 6 years? And to that, he had to say quick commerce could have had huge scale and digitally enabled micro enterprises which can reach small, tiny audiences at very low cost. And that has been the big takeaway over the last 6 years, the big structural change. One of the obvious questions also was that, the mix of DMart's sales actually deteriorated largely because perhaps, there have been entries of a lot of these value retailers in the apparel space as well. To that, he said, yes, there is marginal impact and specific to a certain category such as apparel itself. And that's something that we've seen in the numbers of Zudio, etc. as well. But a lot on the street were also worried about why DMart isn't growing stores as fast as the street is expecting. On that, his assessment is that the external world is tracking how many more stores DMart is adding every year, whereas they worry about how well the stores being added are being actually managed. And that's the big dissonance. But having said that, they would like to add as many stores as possible, as fast as possible. But for that, is there any real estate available to do that? He said, well, that is a challenge, but digital commerce is definitely showing the way. It's quite clear what they cannot do fast, digital can. So that's something that they'll be speaking about. In fact, quick commerce, as per him, is a significantly smarter format for than digital marketplaces, and a lot more relevant for India, which is known for leapfrogging beyond different things as well. And on competition and of course digital commerce, he says that digital commerce is indeed the next big challenge for all of us. And while they will be able to compete, the sudden disruption of general trade needs to be keenly watched. In fact, there will be significantly more digital plays before modern trade evolves and matures, and as a result of it, moats of every business will be slightly weaker than pre-digital times. Entry barriers have reduced for most retail businesses, and that could actually reduce profit pools as well. But talking about growth in the tier 2 and beyond, Bharat as we call, he said that this is a multi-decadal expansion opportunity. And lastly, asked him about what his key objectives for DMart are, and he said adding new stores and looking for moats in the e-commerce space, and growing that will remain the key focus for the company.
Okay, very, very interesting takeaways, not just for the DMart business, but overall for the sector, right? Thank you so much, Mangalam, for putting that into perspective for us. Abneesh Roy is joining in to talk about that. Abneesh, what really stood out for me is the fact that Neville talking about how quick commerce, I mean, it's not going unnoticed anywhere, right? Quick commerce can have huge scale, and digitally enabled micro enterprises can reach their small, tiny audiences at very low cost. So here is a large established player talking about the growth potential in quick commerce. What would your takeaway be from that? And from a listed space point of view, where do you see potential now?
Yeah, thanks. Definitely, DMart clearly is a gold standard in that space. And we have also seen in quick commerce clearly Zomato through the Blinkit, and then Zepto and Swiggy, etc. do really well. For FMCG companies, for example, e-commerce is broadly 6 to 10% of the sales already, clearly taking share both from general trade and modern trade. And within quick commerce, quick commerce is already around 30% of the e-commerce, so clearly growing much faster. Second is clearly now customer is also paying for the convenience. We have seen the ticket size, etc. increase. There is a more rational competition rather than just promotion. So it's a healthy mix of convenience and pricing. So yes, I would say that DMart Ready is a play by Avenue Supermart in that space, and they have been doing good work there. So there is a potential now because the competitive intensity from Zeptos of the world or from Blinkits is more rational. I think Avenue Supermart could also scale that up. But on the physical retailing, clearly Avenue Supermart has a huge runway still left. So I would say it will be still dominated by that. But yes, quick commerce could be an interesting option. E-commerce could be an interesting option long term for all these players.
Okay, e-commerce could be an interesting option long term. But what about the Avenue Supermart share price? Post this interview, I mean, I don't know if you went through the whole thing, but it seems like very optimistic views coming in on the kind of opportunity size that this space has, given that we're now moving from a low income to a middle income economy in India. For a long-term investor, does it make sense to still buy into this stock?
Absolutely. This is a compounding machine. It went through its own challenges last 1-2 years because of very high competition. And there were investor concerns that the pace of the expansion in terms of the number of stores is also not meeting up. If you see first 3 quarters, number of stores were quite low. But in Q4, they added huge number of stores. So we would say that adding of stores is always bunched up. It is generally slow in the first 3 quarters. That should not be the yardstick to measure DMart. DMart is extremely well-run company, and they have mastered that model of owning the real estate space, which helps them in passing on the discounts and best pricing to the customer because they don't have the rentals. So yes, I would say 2 states are dominating. So Maharashtra and Gujarat are still bulk of the stores, but in rest of the 26 states, some states they don't have a presence. In most of the other states, the runway is very high. So yes, it's a compounding machine. When we speak to the FMCG companies, they speak very highly. For example, Godrej Consumer, interesting data point. In the Raymond acquisition, they have done exceedingly well in DMart stores because both have worked with each other. So what we see is FMCG companies launching specific packs for DMart because of the kind of footfalls DMart is able to guarantee, plus definitely the pricing warrior which it is there. So yes, it's a good compounding machine. Valuations is always expensive, but I would say the worst is behind in terms of the margins, in terms of the store addition, and on the discounting from the quick commerce also more rational.
Absolutely. And quick commerce, right? I mean, we spoke about the potential there, and the management also talking about the huge growth in quick commerce. Just wanted your thoughts on how to approach a stock like Zomato now, because obviously we're seeing the kind of growth that Blinkit is delivering and everybody's talking about that. But and now with the Swiggy IPO as well all set to take place, do you think this pie is only going to grow further? And hence, apart from stocks like DMart, do you think stocks like Zomato continue to be a buy?
So I will not comment on Zomato specific because there is another analyst for this. But yes, 2-3 things clearly favoring the overall space if I see. One is, of course, now we are seeing players go to more cities, go for more rational discounting, which was not the case earlier when discounting was very high. Convenience fee was not there. Now a lot of convenience fee is there. And clearly the quick commerce players also expanding the portfolio of products. So a lot of things going right, and FMCG companies and a lot of the other categories also are very, very strongly focusing on this. Recently, we saw Titan, for example, sell Big Basket, and Titan had this tie-up of gold coins, etc. So categories are opening up. So yes, the space should do well. It's more rational competition, more number of cities getting added, and customer clearly is also now starting to pay for the convenience. So all the things are positive, I'd say.
Okay, all right. Abneesh, more questions, but we're out of time, so we'll have you back soon again for more. We'll take a quick commercial break. It's a wrap, actually, on this edition of Bazaar. The market actually is down 20 points. I mean, I think it looked like it's recovering and it was steadying, but no such luck. Take a look at what's going on. So at 10, the fall actually has started at about, 10:18 or so. So this fall is, 10 minutes old, not even 10 minutes old. But it's a sharp one. So the Nifty is now down in the red, 15 points. The Nifty Bank is down about 30, 40 points. And the mid and the small cap part of the market is doing much better. So this is a very much local problem. Market completely ignoring, of course, the positive handover from global markets. It was up and up there, but here there is nervousness, which is emerging once again, something we've seen over the last many days now. We'll wrap up. Thank you very much for staying with us from the Bazaar team. Thank you. And Chartbusters will pick up on the action in just a bit from now.